gold going up. So I don't want to say it's the ratio of useless commodities to useful ones, but it does show you when people are very, very worried about big picture stuff in the world, buying a lot of gold, and also very despondent about the likelihood for the global economy doing better down the road. So right here, you see a higher high in this ratio. Not going to say it's a timing mechanism, but it's going to fit alongside a lot of other things that are saying maybe we have the ingredients for some kind of short-term peak in panic coming up, guys.
Mike, I guess today, though, and indeed more broadly over the last couple of months, it's been very much the oil side that has had much bigger moves.
It has. Now, gold did trade up to a high, but you're right. It's been more violent on the oil side. That's been the leg that has shot this ratio higher.
Do you see this as a recession tell or just a sentiment gauge?
Well, I think it's more of a sentiment gauge, too. And I think, there's the numerator and the numerator and the denominator are two very different things. And so they can move very quickly, like Wilf pointed out. I think right now it's really being driven by oil prices sharply dropping.
Gold sort of being flat today, you could argue, is one of the few things out there that suggests fear isn't as broad as perhaps it could be.
And or that they're selling everything.
Or
that's the other part.
They're taking profits. So
let's have a look at the S&P 500 heat map very quickly with just 22 minutes left of the session. Wow, just a handful of stocks there in the green at the top. So many stocks in the red. The broader S&P 500 down 6.2%. It's off the lows. We were down more than 8% at the low. The Dow's on pace for its biggest point decline in history. Joining us for more, JJ Kinahan, Chief Market Strategist at TD Ameritrade, and David Balin, Chief Investment Officer at Citi Private Bank. A very good afternoon to you both. JJ, I'll start with you. How fearful have clients kind of been over the last couple of weeks and today?
Well, it is interesting. Our trading has picked up pretty significantly as we head into March. But overall, I think our clients have been, if you look at our IMX, which came out today, they've taken less exposure to the market, but certainly not to panic mode. They're down about 9% this month in terms of overall exposure to the market from last month. They started to buy fixed income toward the end of last month as coronavirus picked up more in Asia, et cetera. But, talking to the folks on our phones, et cetera, it has not been a sense of panic. And I think the market overall, the first sense of panic I really saw was last night in the overnight future session. Over than that, it's been an incredibly orderly sell-off.
Where are they cutting exposure? What kind of names?
Amazon, Netflix, which both hit 52-week highs last month, so I'm okay. Twitter, Square, those names, obviously, with Mr. Dorsey being involved in, a lot of things. I know the news came out this morning. Activision, those are the types of names they're getting out of, Sarah. And where they're heading for is names that are well-capitalized, kind of I call more traditional names. Apple, Microsoft, Disney, paying some sort of dividend. I think people want names that have sort of stood the test of time a little bit more right now.
Mike, does that suggest, it's a small sample, but not suggesting you've only got a small number of clients. But Mike, there's still another wave of selling to come if retail investors haven't taken part yet, or are we just trying to find?
It's tough to extrapolate just from that. I mean, I do think you can say that perhaps this hasn't gone on long enough for there to be a kind of full wholesale give-up type trade among retail investors, but there have been pretty heavy outflows from things like ETFs, and the survey stuff is mixed at this point. But I do think time has been the missing element.
David Balin focusing on Citi's private banks, so I guess some more high net worth individuals. What have your clients been doing, and what have you been telling them?
Yeah, I mean, they've added to their gold and their treasury positions in February, and now we're seeing them begin to move back into the market in certain of the areas. We saw it first in Asia, where a lot of those clients have been buying their local markets. We saw today they're actually buying U.S. markets. I think that this is a particularly severe sell-off relative to what's really going on in the core economy. We've advised them, that once markets get down about 20%, that becomes an attractive entry point, generally speaking. And in some ways, these externalities, right, which is you have a coronavirus situation which could last 2 to 4 months. It's very significant health, economic, and social issues. But when you look at the core economy going into the crisis, the health crisis, you can see just how strong it was in general. And we had expected an up year in earnings in the United States of about 7%. So even though we revised that down, we see clients are much more interested in understanding, is this going into a recessionary period now into 2021? Or do we actually see this as a exogenous shock that's going to last for a reasonably short period of time of 3 to 4 months? And that really is our primary view right now. Our clients are actually, as I said, buying into equities, into different sectors of the market right at this time.
We're looking at an S&P down 6.4%. David and JJ, stay with us if you would. We are getting some new comments coming in from billionaire investor David Tepper. Steve Leisman has that for headquarters, at headquarters. Steve?
Sarah, thanks. I did have a conversation with David Tepper about how credit markets are functioning. He did not seem overly concerned is the overall impression I'll give you. He said he is not surprised that in some market bid-ask spreads have widened, given how much volatility. He said you have to have that in order for people to make money in there. He said it's a risk management problem, not a liquidity problem, by which he means there's players out there reducing their risk exposure, even though there may be sufficient amounts of liquidity out there. He said there's liquidity in markets, but not for all contract sizes. Some of them there it has dried up, but mostly he is able to make the sales and the buys that he wants to make. And again, he just scoffed at the idea there's anything like the financial crisis. He says there is now much less leverage in the banks. And one other thing, adding to the liquidity issues, he says the desks themselves are split up because of the coronavirus. He says some people are here, some people are there. He thinks the situation on the desk will improve when they're back together. And I can add to that personally, Sarah. I called a repo desk this morning to see how credit markets were trading. And the guy said, well, I can't really tell you too much because I got one guy at home and I'm here, so we call back later, is what he told me.
Well, that's pretty interesting, Steve, just to follow up on that. I mean, I've spoken to all of the banks over the weekend, and my gauge of it is roughly 10% or so of the headcount they're taking off-site into their backup locations. But I'm surprised if there's a feeling out there that has stopped the proper functioning of markets. I mean, clearly, either way, Mr. Tepper's conclusion was there's plenty of liquidity in markets.
Yeah, I think that's the important part. I guess it depends on who that 10% is, Will.
It does also, though, highlight an issue that if this does get a lot worse in terms of the need for quarantine for banks, that it would be hard for the trading floors to function with everyone having to go home. That's why it's so important to have these backup sites.
You have to believe there's a reason people go through the pain of getting on the train to the subway to go into the office to get on the desk. There's some rationale for that. Otherwise, we'd all be doing it at home anyway. And so you have to believe there's some informational or process reason why they do that, and that there's some diminution in that functional process there when they stay at home. And that's what I heard this morning. I wasn't able to get a clear read from one desk. Tepper says he's hearing it from other people out there that there's some problems in functioning of some of the desks because they are spread out. So, and he says that's a temporary problem. Overall, he thought some of these issues out there were pretty temporary. He did not seem overly concerned of the critical issue, as you point out, Wilf, of the functioning of the markets. Things can fall, but they seem to be falling, at least in a reasonably orderly way for most markets.
Any sense of whether he's buying or selling?
Actually, to prove something to me, he actually bought, well, he went through the process of buying a contract on the phone with me to prove how there was certain liquidity out there. But I don't know overall his book, and I didn't ask him.
All right, Steve, thank you.
Thanks.
Steve Leisman. I mean, again, another, I would say, positive read, right, JJ, that the market is functioning well, there's liquidity. It's not the kind of crisis-style, panicky reasons that we get.
Absolutely, and the markets have performed very well. I mean, you know, sometimes people criticize market structure. Overall, I mean, I'll look again, it's a sample size, but it's our sample size. In January, we averaged 1.48 million trades a day. We are now March to date. We're averaging 2.3 million trades per day. Everything's functioning as it should, and it's been, in my eyes,
so
really.
So then you have to wonder what a 6% down day is actually trying to tell us. I mean, is that a fundamental story?
Well, it's just that we saw, you know, we're just seeing corrections over time. It's the old adage, you know, the market goes up the stairs, jumps out the window when it goes down. It's jumped out the window even more so than most days, I think. The bond market's been kind of warning us over the last few weeks, and I think the biggest issue, Sarah, is if you look at like tariffs last year, there were dates people set. You know, if this doesn't happen on this date, we'll do something. With the coronavirus, there's no date, and that's tougher for people to get their arms around overall.
JJ Kinahan, David Balin, thank you both very much for joining us. We've got 14 minutes left of the session. We're down 6.5% on the S&P 500. Time for the last chance trade. Lindsay, what are you going for?
Well, I think when you look at the market for opportunities, what you really need to take into consideration is the environment that you're operating in. And right now, that's an extremely volatile environment. It's one that there's a lack of direction and clarity with regards to economic data and earnings forecasts. And for that reason, I started looking at GLD. I know Mike talked about how there are some different indicators where maybe it's starting to become a little more overvalued. But when I think about gold, this yellow metal, it really benefits from central bank activity, and that's when monetary policy is easy and going to continue to ease. Also, when there's an expectation for fiscal stimulus to increase, gold usually does well. And when we have this amount of uncertainty, you've heard many guests come on your air all day today talk about they don't know where the economic environment is. Gold has historically been a very good store of value, and it usually outperforms in a down market. So for that reason, I took a look at GLD.
It is odd to see that it's flat on a day the market is down 1,700 points.
Well, you know what? The same thing happened last week. It declined, or 2 weeks ago, it declined 5%, then popped 7%. So I think that you just see some investors really taking profits here. If it's to make margin calls or just really take money off the table and put it somewhere else that has come down significantly.
Going into yen, Swiss franc, some other favorite safe havens. Coming up, we're going to have much more on the sell-off and how investors can protect their portfolio when we are joined by Mad Money's Jim Cramer. Looking forward to that.
We've got 12 minutes left of the trading session. We're now in the closing bell market zone. Commercial-free coverage of all of the action going into the close.
Today we've got Ally Invest Lindsay Bell, CNBC Senior Markets Commentator Mike Santoli, and Cantor Fitzgerald's Global Chief Market Strategist Peter Cecchini here to break it all down. Let's kick things off with the broader market. The Dow is now down almost 1,700 points, on pace for its worst day since December 2008 and looking to close at its lowest level since January 2019. The S&P 500 plunging more than 7% at the open. That caused a circuit breaker to actually halt trading for 15 minutes, reopened, and now we're seeing the S&P fall sharply as well to the tune of 6.3%, looking at its worst day since 2011, though I think May 2010 is also in play here. That was the day we saw the flash crash. I mean, it is broad and it is large, Mike. Yeah. A lot has to do with oil, and I guess a lot has to do with the coronavirus. How would you put it into context?
I would say it's a kind of complex correction in that sense, in that you basically have all these different elements that are pushing the market around. I think today you get to further extremes, right? A week ago you were able to say, wow, this market's getting a little bit oversold in the short term. 18% in 3 weeks. It's a pretty big bite. I think it probably takes incremental bad news on a very immediate tactical basis to get it too much lower unless we have something blow loose in hedge fund land or in credit markets. But that being said, I don't think you've created true absolute value cushion under this market because we started from an expensive spot. So I think you can kind of play that both sides and say, wow, we really ought to be rallying here. That time in 2011, Sarah, you mentioned we were down 6.66% on a Monday, and you did rally big the next day, but it wasn't over for the correction.
Peter, you were cautious before all of this, so congrats on that. Where are you now on this? Are you starting to turn more constructive or still not?
I agree with Mike. I don't think there's enough of an equity cushion underneath the market yet. I think when we look at it fundamentally, if we really do think there's a 5% contraction in earnings, which we've lowered our base case, which was at the beginning of the year for flat earnings, to down 5, and we look at a reasonable multiple based on what we think our equity risk premium model tells us, about 16 times, you're looking 2,450 to 2,500, which would be the sort of equilibrating fundamental anchor, let's call it. But we know that markets trade excessively out of disequilibrium often. And it was my view, as you guys well know, I came on here bearish quite a bit when the market was in my face. And I said, look, I can't buy into this rally for lots of different reasons. And I think we're getting close to where we should be fundamentally, albeit still not quite there yet.
Now, energy, of course, has been in the eye of the storm today. The sector down sharply to the tune of about 18 or 19%. It's on pace for its worst individual day ever. The move comes as oil prices dived in the session on fears of a price war between Saudi Arabia and Russia. WTI crude saw its worst day since 1991. Energy stocks taking a massive hit because of that. ConocoPhillips and Chevron faring better than others, hitting levels, though, still not seen since 2016. Meanwhile, Exxon hitting its lowest level since 2004. Halliburton, its lowest level since 2002. Mike, interestingly, the majors, if we focus on them here, down sort of 10%, 12%. BP and Shell down close to 20%. I mean, that is pretty extraordinary moves for companies that, relative to the rest of their sector, have strong balance sheets. And I don't think any of the analysts you speak to, including the ones we had on earlier, think that those companies, the majors, have any questions about their long-term future.
Right, and they're not as leveraged to the actual commodity price. The majors are not as much as the exploration guys. It's a give-up trade, I think, in energy. It basically says this is going to be just too hard for too much of the industry. We're not really talking about growth mode. We're talking about shrinking, and we're talking about, bankruptcies and all the rest of it. The most interesting question market-wide for me is whether the corporate bond market can sequester energy away from the rest, and whether we can say, look, this is a blasted out area, it's got to take pain and not have it filter into other types of corporate credit. I think it's an open question, but that to me is going to be a big tell in terms of whether the stock market can kind of find its way.
Other question to me, which I think relates to the overall stock market, is, Peter, even though it's a small section of the stock market, these energy stocks, what about the economic impact on the U.S. economy? How big of a deal is that if we start to see energy companies fall, and what will it mean for our growth?
Certainly, it's been an area of jobs growth for quite some time. And by the way, just to sort of take it back for a second, the reason why a lot of these E&P companies have been able to survive is because rates have been so low. Low rates have created a lot of overcapacity in E&P for companies that should not have survived, that are still burning cash. That has led to the necessity of this global oil price shock. So this is, to me, a consequence, an unintended consequence of low rates for far too long. And even beyond where we're talking about the importance of E&P companies to the economy, it's an indication that there are probably other areas that are stretched as well in corporate credit, well beyond, I think, E&P.
I think it also has political ramifications, as I mentioned earlier. Texas, Arkansas, a lot of these hard-hit states, North Dakota, they were all Trump states in the 2016 election. So, I mean, any pain there could have ripple effects as well. Airlines also getting crushed. The ARCA airline index down more than 30% so far this year, down 6% today. This as the CDC is urging people to avoid unnecessary travel. American, United, Alaska, and Delta Airlines all down more than 30% from their 52-week highs, Lindsay. When do these airlines get too cheap?
It's a good question. I think that we're going to have to see stabilization in airline travel. The good news for these guys is oil prices coming down, right, too. That could be a silver lining for them, too. But, again, it gets back to that big question of uncertainty. When are oil prices going to bottom? What is the economic impact from coronavirus here and globally? When is China going to get back on its feet? When is the 10-year going to stabilize?
That said, if you're looking for a silver lining, and maybe a bronze lining, these stocks, or some of them, are actually above their intraday lows on Friday.
Right.
Because they tanked to the open on Friday and they recovered, which, given that they are in the eye of the storm for various structural reasons, is a small bronze line.
It is pretty small right now. I mean, I do think it's a high fixed cost business that if you have idled capacity and top lines going down, it's not a good story. But they also at least screen out as looking not all that expensive if the balance sheet is okay. And I think we might be talking about post 9/11 style government support of some sort for parts of the travel and airline industries. Who knows if this drags on.
Let's move on to tech with 5 minutes left of the session. John Fort has a look at how that sector's performing today. Hey, John.
Hey, Wilf. Yeah, here's a quick rundown of the landscape, really starting with the S&P Information Technology Index. 1441 would be the bear market level there, down 20%. We're not quite there yet, about 20 points away, but some big individual tech stocks inside and outside that index are. VMware, Cisco, and Intel have all lost more than a quarter of their value since their 52-week highs. VMware has lost almost half. Now, on the flip side, Netflix, Intuit, and Alibaba have lost less than 15% of their value. Stay home, watch TV, pay your taxes. Today's worst performers in tech include recent high flyers like Tesla, Shopify, and Micron, all down 10% or more, while suffering least Chinese e-commerce player Pinduoduo, video conference player Zoom, and enterprise software giant Oracle, though that one is near the lows where it's been trading for the past 2 years, guys.
John Ford, John, thank you. How do you approach tech right now, Peter?
Well, I'm cautious there, too. I mean, valuations have come in quite a bit.
Even at the stay-at-home stocks like Netflix?
No, I mean, you have to differentiate clearly, right? But when you talk about cyclicals like semiconductors, and I've been making a late cycle case for a little while now, And, they've been sort of the poster child for overvaluation, in my view, given where we are in the cycle.
What do you like instead?
Well, I've liked the REITs. I've liked them because of my view on rates. Our view has been rates would be lower. Our view is that the curve would invert this year. And for that reason, you get a tailwind for cap rates in a lower rate environment. So we've liked the REITs.
Are there any pockets of tech, Lindsay, that you would be buying?
Well, I do think that some of the software companies that have come in on the back of this pullback could be more interesting now, given the valuations coming in. But also, I think just more broadly, if you look at the NASDAQ action in the last week, on certain down days, they've been down. That index has been down less than the larger cap S&P 500 index. So I don't know if that shows that investors are still willing to put some of their money into these types of cyclical sectors because, when we usually come back from big, sharp pull-offs like this, you see the cyclical sectors bounce fast.
Mike, what are you seeing in the market internals?
It's a washout. If you just look at the New York Stock Exchange up versus down volume, it's like more than 95% to the downside. As I said, you're getting more extremes in this comprehensive selling we've seen today. Then take a look at new highs versus new lows. Something like half of all New York Stock Exchange stocks, more than half, made a new 52-week low today. So what you can say is a ton of selling has happened at a concentrated period of time. It's the makings for some kind of relief out there, but you can't really necessarily say it is right now. And then the volatility index, it is up. It's telling you that things are still treacherous. There's a massive hedging bid in there. It's well off its highs for the day of around 60 or low 60s, but still telling you that this is an extraordinarily dicey tape, at least right now. So the contrary thing is when it spikes and comes down hard, that tells you maybe the fever is broken. Before it spikes, when it's still elevated like this, be careful.
Yeah, there's a lot of spiking going on. We've got just about 2 minutes to go here. Let's go uptown to Frank Holland at the NASDAQ. Frank.
Hey there, Sarah. The NASDAQ falling as we approach the bell, down just about 7%, crossing the threshold to be one of the worst days since the financial crisis. Chip stocks and tech stocks taking some of the biggest hits during the sell-off. Tesla down right around 12%. Lower gas prices, another headwind for that company. Mercado Libre and CDW both down around 11%. Consumer stocks also taking a big hit as part of the sell-off. Now tossing things back over to Wilfred with more. Wilfred?
We've got just under 90 seconds left of this roller coaster session. The S&P is down 7.3% just today. It was down more than 8% at the lows, so we're not far off those lows. 7.4% as we approach the close. Energy in the eye of the storm. Here is ExxonMobil. This is a giant major with a relatively strong balance sheet. It is down 12%. Why? Because oil prices have tanked. They're down about 26% just today as we approach the close. What else has suffered significantly? Banks. Here's Bank of America since the start of the year, from peak to trough February to today, down 38%. It's down about 15% just today. Why? Because of the move in yields, which continue to slip. We're off the lows today, but we are still about 0.5% on the 10-year. The best performing sectors today are the defensive ones like staples and healthcare. They're still down about 4% themselves. Bring in Bob Pisani as we approach the close.
Here's what matters.
Snapshot of all of the markets. We are down, Bob, as we approach the close, 7.5%.
Yeah, the important thing is the test of the circuit breaker system today. At first 15 minutes, the system held up fairly well. And if you'll notice, things were much calmer after that. There'll be a lot of post-mortems on this. This is the first one we've even had in the modern era. But for the moment, it appears to at least pass that test.
Calmer, perhaps, Bob Pisani, but we are down more than where the circuit breakers kicked in this morning. The S&P closing down 7.7% in points term on the Dow, over 2,000 points. Sarah, back to you.
That is the worst point drop for the Dow ever. Welcome to Closing Bell, everyone. I'm Sarah Eisen. Wilfred Frost rejoining me in just a moment, along with Mike Santoli, CNBC senior markets commentator. Take a look at this ugly, ugly day on Wall Street. The Dow closing down 7.8%. Worst day for the Dow since December 2008. And as I mentioned, worst point decline ever. The S&P 500 losing 7.6%. Worst day for that index since December 1st, 2008 as well. The tech-heavy NASDAQ also getting crushed. This was a broad selling day, down 7.3%. Worst day, it looks like, for the NASDAQ since 2011. The Russell 2000 index of small caps also getting smoked. A lot of banks make up that index as well. Banks were among the hardest hit in the market. Russell 2000 down 9.44% on the close. Energy got hit the hardest after crude oil declined almost 25% as Saudi launches a price war in the middle of what is perceived to be a big shock in demand from the coronavirus fears. Oil, by far the worst performing group in the market. Coming up, Mad Money's Jim Cramer joins us with his thoughts on this massive market sell-off. He'll tell us what he thinks you should be doing right now with your money. Joining us to talk about the market today, Eric Knudsen. He is multi-asset CIO at Neuberger Berman, which manages $365 billion in assets. Still with us is Peter Cecchini, Cantor Fitzgerald Global Market Chief Strategist, Lindsay Bell, Chief Investment Strategist at Ally Invest. Though first, Mike, to you on what we just witnessed today. That was brutal.
Obviously brutal. I mean, the market's rushed toward a place to say we have to start handicapping the probabilities of a recession in this country. Certainly, we haven't priced that in right yet. The verdict is not yet in. I think you could probably look at the washout conditions in the market and start to make a case that there's been enough selling for now. If it was just an equity story, I do think everyone has one eye though on what credit spreads are doing and just the volatility readings out there, which suggest a certain contingent of market players are kind of trapped in forced hedging, and there's a lot of unease and bad vibrations in the market. That's the way it is before you get some kind of a big reversal rally, but it's also the way it is before the market deepens into a deeper correction.
Peter, on that note, what are you looking out for, the key triggers that would make you turn to be a bit more constructive, a bit more bullish again?
Well, I'm looking at the rates markets, and the rates markets have been singing a bearish tune for quite some time. The 10-year dipped to about 35 basis points.
Although it rallied up to 50 basis points.
It did. Big moves all day long. The 3-month to 10-year spread, not to get too esoteric, intraday moved 30 basis points. It was down 20, and then it was up 10. It's really a really interesting time in the rates market. So what I would like to see is a bit of a steepening in the yield curve, which likely cannot happen because Fed funds right now is still well above the 10-year. So I'm actually expecting the Fed to move at its next meeting with another series of cuts, and then perhaps I will get more constructive. But the problem is the fundamentals have been weak for a while, and the coronavirus is just, as I've been saying, an extremely heavy straw on a very weak camel's back.
So junk spreads have jumped the last 2 days, but they're still below where they were in 2015,
right.
2016. So do you think we get to that level or above before the pain is over?
Well, I'll tell you, it's interesting. You know, I grew up in a world where credit markets led equities every time. A couple cycles that I have lived through, that was the case. Now I think it's different, and I think the equity cushion under credit spreads has allowed for a relative value mindset that has persisted for a long time. In other words, if you're taking down a new issue and a company has a massive first loss cushion beneath you, you're really not all that worried about being repaid. But suddenly, as your equity cushion diminishes, you say, oh my goodness, maybe I don't care about that extra 10 basis points on the break. I really care more about whether or not I'm going to get repaid at the end of the day.
Eric,
and that's the shift.
Just want to bring you in here, Eric. What are you doing and what are you telling people to do on a day like today?
Well, first of all, we were telling people this morning that they should get ready for a long haul, that this was not going to be resolved quickly. As we met with our senior investors at our firm over the weekend, we identified a couple things that we were watching for. One was we observed that up until Thursday, Friday, this sell-off had been actually pretty orderly. Correlations had held. Stocks were going down, rates were going down, but credit spreads hadn't widened that much. We started seeing that change Thursday and Friday, and we identified a couple things that we thought were going to potentially drive a very sloppy day today. One is we observed that the oil price drop really put the market in double jeopardy because that has more of an impact on credit. And we expected a pretty ugly day for credit today, and we got it. The other thing we observed is that you hadn't really seen a big, and one of the identifiers we picked up was a multi-thousand point drop on the Dow, and that would indicate that we had really gotten into the selling and very negative sentiment, and we just got it. So we identified a couple levels where we wanted to, where client portfolios were underweight equity, and we did come into the weekend underweight equity. add some equity exposure. And we began doing that this afternoon. 2720 on the Dow is a 20% drop. That's an important support level. We're adding just above that level. And we're also looking to take advantage of this higher volatility by selling options on equity indexes to say we're willing to get paid a lot right now to buy equity at lower levels from here.
Eric, what did you buy in the equity market? Broad indices, or were there sectors or stock specifics?
Yeah, from a multi-asset standpoint, we just implemented with S&P futures, partly for ease of liquidity and implementation, and partly because it reflects a quality orientation, and that's something we want at this point. It's not yet time to go looking for kind of deep value or bombed out areas of the markets.
Okay, let's get a summary, by the way, on this crazy day that we just had. Bob Pisani's on the floor of the exchange with a breakdown of a crazy day, as I said. Bob.
Yeah, and so the good news is the circuit breakers kicked in very early, added liquidity, calmed the markets a little. The bad news, of course, we did end of the lows for the day. Energy down 18, banks down 14. Industrials down 8%. I just want to show you ExxonMobil down roughly 11% on the day. This would be the lowest close for Exxon since 2004, believe it or not. JP Morgan Chase down 13%. Or so. That was the worst decline since March of 2000. You got to go back to the financial crisis to see a decline of that and this kind of percentage on a daily basis. Industrials generally fared poorly. Caterpillar and 3M as well. 3M down 5%. They're 6%. I'm sorry. You see that? That's a 4-year low for 3M. And Dow Inc., which you can associate with the truly global industrial materials economy, global coatings. Think that is not a typo there, down 21%. Remember, it just came back to the public markets a little about a year ago. That is, of course, a new low for that stock. Guys, back to you.
All right, Bob, thanks. Another historic day as well for the bond market. Let's go to Rick Santelli at the CME in Chicago. Rick.
Hi, Sarah. You know, markets right now are trading some very important levels. Look at a 24-hour of 10s and realize that Friday's low yield in 10s was 65.65. Right now, today's high was 60, and that was after a 31 print. And the point is we're trading 59 now. If we leave gaps, and we left a gap, and we go down below the lows, which are 31 before we fill that gap, that is much more bearish for lower rates. So filling this gap and what we do once we do is significant. Finally, if you look at the long-term chart of 10s, a lot of it's technical. The minute you took out those double bottoms at 12 and 16, it accelerated. Dollar index, as soon as you took out, see the year to date, where it closed last year, it accelerated. This is important. Uncertainty is always addressed by technical features, so you need to stay on top of them. Sarah, back to you.
All right, Rick, thank you. Energy stocks got absolutely crushed today. Our next guest downgraded almost every exploration and production company he covers on what he says is a potential energy Armageddon. Joining us now is Neil Dingman, Managing Director of Energy Research at SunTrust Robinson Humphrey. Explain what you mean, energy Armageddon. I mean, we got a taste of it today, but how much more is likely to come?
Yeah, thanks, Sarah. You know, again, you hit it earlier, and that is it's unprecedented to see this kind of pressure, both not only on the supply side, but the demand side. Again, here, we don't know what the fully demand destruction is going to be, nor do we know how much the supply war is going to cause supply to continue to ratchet up. So standing back, taking a look at that, we thought, you know, prices certainly could get on the 20s. We have seen that, and we think they could stay there for a little while.
Peter, just want to come back to what the stocks have done today. Do you think the oil stocks are suggesting large swathes of this industry are going to go bust, or is it just a move based on, earnings estimates have to come down?
Well, I think, again, you've got to bifurcate, so similar to your technology names. The big companies that have, good balance sheets will likely survive, and that'll be an advantage to them. But the smaller guys that have access, that need access to capital markets that are cash flow negative will suffer, and the privates will likely go under very, very swiftly.
Talk about within your coverage, Neil, who's going to suffer most, and what does that suffering actually mean with the price of oil at $31 a barrel?
And there's definitely a number of names that have both maturities and, there's the RBL redetermination coming up. So when you look, some large companies, Oxy obviously has a lot of debt after the Anadarko merger. Chesapeake, of course, has a lot of debt outstanding, as does even, better credit such as an Apache. All those have relatively high levers with some maturities coming that they're going to have to address, just for some large companies there.
What's the key, Neil? What's the key oil price and the length it has to remain below before those companies start to feel the pressure seriously? Is it 1 month where we already are, or do we need to see another leg down and it lasts for the rest of the year?
Most of these companies, again, they've got to be closer to $40. So again, we're obviously quite a ways from that. So to me, if we're down, let's call it 2 quarters, well into the back half of this year, and we're still under $40, it definitely will be troublesome. I'd put it this way, Wilfred, I don't think any of my companies make free cash flow at $40. They're going to have to figure out other things. In fact, direct quotes from my CEOs today said, it's all about survival for us. It's not about valuation. And I think that's very much what most of them are looking at.
The president tweeted out, Mike, today on the oil prices that, gasoline prices go down for Americans. That's good. It puts money in their pocket. If you look at what stocks actually went up in the S&P, I think there were under 10 of them. One was Dollar Tree. I thought the other dollar store
Walmart was up for part of the day as well.
Clorox. I mean, there are, there is a silver lining for the consumer.
Sure.
I'm not sure, though, if you have coronavirus fears, you're going to go out and spend that money.
Right. I mean, the buying of necessities trade will work in this environment. I still don't think that from a stock market
They've been
perspective,
taking over
the small windfall in terms of price per gallon is that significant. Because the oil intensity, that's just not as big a portion of the consumer expenditure set as it used to be. It doesn't hurt. It's an offset. But I don't think it really changes what's going to be a real retrenchment cycle in the energy industry.
The amount of jobs lost that the energy patch is going to have to go through, I think is going to have a much bigger impact than the couple dollars that families are going to have to spend from the savings in oil.
Peter, is there a sector you'd buy today?
Again, my favorite amongst the carnage is the REITs, and I've been singing that song. I'm sticking to it.
Eric, to get excited about.
Yeah.
Eric, final question to you: is there a U.S. S&P 500 sector you'd buy today?
Again, quality and yield. We think that once the dust settles here, where you look at where treasuries are, there's going to be such a demand for yield. So we're looking at quality and we're looking at yield. So REITs can certainly work. We're also looking on the bond side. We think there are going to be some really interesting opportunities to be a liquidity provider in investment-grade credit. And there's going to be a lot of demand for those bonds. And right now, you can pick some up at a pretty good bargain.
Okay, we'll leave it there, everyone. Thank you so much. Neil, Eric, Peter, and Lindsay.
Thank you.
For more on this historic sell-off, let's bring in Mad Money's Jim Cramer. Jim, as always, great to have you with us, particularly on a day like today. I just want to read out some of these statistics for you. This is the worst point drop for the Dow ever, the worst percentage drop for the S&P 500 since October 2008. Jim, do you feel that you're getting reminded of the 08-09 financial crisis on days like today?
No, I think I see much more of a reminder of the J-Powell bear market. And unfortunately, we're still not to where we were in the bottom, the Christmas week of 2018. We fell down there, S&P 2339. Dow 21770. I think those are good levels because I think that people think, listen, it's going to be a recession. And if it's going to be a recession, then we still have a little bit more to go. I did see some things to buy from my travel trust the other day. First time we bought anything. Because there's just such declines in the pharmaceuticals, which I think should hold up. I just saw Sarah mention that the Dollar Generals and the AutoZones go up. And, that's okay. I get that. There's a recession. But I want yield. And there's finally some yield. And it's great to see.
Where are you looking for that yield? Which sector in particular?
Well, I've got to tell you, I look at AbbVie, and I think I can't believe I'm getting that gift. How about Bristol Myers back over 3%? Bristol just made that acquisition with Celgene. They've got some huge cost savings coming, and it'll be accelerated buyback they're doing. There's just so much to like about it, Bristol. Because I say like about it because you can buy it here, and if it goes down, which it could because it's part of the S&P, then you can buy more of it, and that's what I'm really looking for. I'm looking for situations where it could go down and you don't say, oh, I got it wrong. You can say it went down. I say, oh, good, I like that. So I think that's good. I don't even mind Amazon here. I think that you can buy some Amazon and then buy some more just on a scale because, holy cow, if you're really staying at home, that's the only way to shop.
17 people in
Jim, I'm
connection
looking
with
at my
suspected
dashboard here. JP Morgan Chase, 3.85% dividend yield. What do you make of that?
I'll tell you which one you want to go. I'll see you one and raise you one. How about Charlie Sharp at 6% without the problem of Elizabeth Duke being the chair? I mean, don't you think that's interesting? I mean, there you got a guy with a full news slate of people with Maxine Waters all over him, and he didn't do anything. So I kind of even like that. 6% with Charlie Scharf. I'll bank with Charlie.
Police in Hong Kong have
on
arrested
that point, though,
17
Jim, one
people in
big question
connection with
that always
suspected
comes out when
homemade
people say, oh, it looks like it's a good dividend yield, but might that be a sign the dividend is going to be cut? With the banks, do you take strength on the fact that they've got a lot of buybacks they could cut first, that those yields, 3 to 6%, whichever one we're looking at, are very safe?
Exactly. Look, if Mike Corbett doesn't want to continue to buy 8% of the company back because it's below book, and that's tangible book, he can stop doing that if he wants to. I look at something like J.P. Morgan. Obviously, yes, we want Jamie to wish best of health, but it really is amazing. I think if that actually Jamie were back at his desk, he would feel, well, wait a second, I'm getting a chance. I know people hate the banks. I heard all day that the oil companies can bring down the banks. That is actually not true. I didn't like the fact that J.P. Morgan apparently did a revolver with one of the cruise ship companies, because I think the cruise ships have become wasting assets. But when we look at the oil companies, they're not all knuckleheads. They're not all Occidental.
Just on the broader market, Jim, there are so many uncertainties right now on coronavirus. How many actual cases are there in the U.S.? Right. What does the mortality rate actually look like? I mean, what do you think it's going to take for the market to be able to see out onto the other side? What is the headline or the news?
We want fiscal. We want some sort of fiscal commitment. We want public health to have all the money at once. We want a Manhattan Project to try to solve this, and we want the test kits. I mean, you take a look at Japan. They have not had their numbers are peaking. And the main bulk of the numbers are from a cruise ship. I would love to see our numbers peak. I don't want to be Italy. I want to see what happens in South Korea. And I'd like to be able to test. With the test kits, I know my confidence would come back. I understand that the president wants to tweet that all is well. I think you have to hope for the best and prepare for the worst. You don't just hope for the best. That is a sucker's game.
Jim,
you mentioned they're not all knuckleheads in the oil industry, and we've seen some massive moves today, even with the strong balance sheet oil companies like a BP or an Exxon. But putting those aside, when you focus on some of those smaller, over-leveraged oil companies, is there a chance that one or two of those go bust? And if that is the case,
why do you say one or two? I think that of the 37 that I followed, courtesy of Rusty Brazil, I think fully maybe 9 or 10 can go. I'm just saying that I'm not going to sell Wells Fargo because of them. I would sell the oils. I don't care for any oil. Now, I didn't care for any oil beforehand. I know the industry felt that I was a pariah, an apostate. I just don't like them. And now I really think that people are joining me because if it's lower longer, there's no place to hide.
But Jim, if you've still got a handful of those companies then that could go bust until we get those headlines, will the broader markets not follow in line with that?
I think that would be a mistake, because these companies are no longer a big part of the S&P. The Occidental shoe has to fall. The Occidental shoes have to fall. There you saw the bonds trade down 25 points today. The big 49 bond, the 4 and change 49 bond. You can't. I think that when that goes and you see it as the lead story in the paper, and Warren Buffett lost a lot of money on it, if that does happen, I think that could cause another leg down in that group. But what I'm looking at is you remember the banks were stress tested 25, 26 for the oils. I feel better about the banks than I do any oil company.
Jim, just overall, I mean, is it panic? What do you say to the extreme sentiment shift?
I wish it were, Sarah. You know, they did the halts, and suddenly everybody's calm and they're picking. You know, the picking thing doesn't work. We got to wait for this is a different market because we didn't count on the oil problem. Before the oil problem, we thought maybe we're okay. And look, I want to believe the president. I want to believe that if we tested everybody, everything's pretty good. That would be terrific. But the fact is, people are working at home. Deals aren't closing. Restaurants are hurting. There's no backstop of no interest loans for the people who, frankly, deserve it because they're hardworking people. When I speak to Dave Tepper, I know that earlier Steve Leisman talked to Dave Tepper, and I know he made it sound like that Tepper's like, hey, sanguine about some things, an orderly bond market. But we both feel that without fiscal stimulus and some kind of more aggressive leadership from Washington, we're going to run into another down day like this until we get to where Jay Powell put us in December of 2018.
I do think it was notable that, there were reports, and Eamon Javers reporting earlier, that the Trump administration, the economic team, is starting to weigh measures to deal with this, paying for sick leave and business, but it didn't really do much to give the market a confidence boost.
Well, they didn't really come out. I mean, plus you have Senator Mnuchin. I think he needs to come out because the president's got himself in a bit of a box. I mean, if everything's so darn good, like he says, then how do you therefore then offer these different programs for the small and medium-sized businesses, which we know will be crushed? And any of us who have small and medium-sized businesses, we're looking and saying, okay, if we have 4 or 5 bad weeks, can we carry people? Can we carry people? Yeah, and these are totally legitimate businesses all over the country. Where can we carry them? And so I think that that's a big problem. And I think that the credit issues that drive J.P. Morgan down 14, American Express down a lot, these travel and leisure and credit card are frightening people. And I wish that they didn't, but they are frightening people. So I expect another day that's not so hot, if not multiple days, if the COVID really heats up again, which I think we all think will. Do you guys think so?
Jim Craig?
Are you worried?
I think it's hard to predict on an individual day,
worried?
But
do you wash your hands all day and wear Perel?
I wash my hands all day, but I'm
all day. I wear
but I'm
rubber
not
gloves
too worried outside of that.
You're not?
No, but I take cautions. Like everyone should take cautions, and I'm not going to unnecessarily get on a plane, and I'm definitely going to wash my hands a lot. Jim,
well,
Jim, we're going to listen to Dr. Fauci, right?
I love Dr. Fauci. That last line, man, Royal Caribbean. I mean, can you imagine if you're like watching that show? And he said, "Don't take a cruise ship." It's like, wow, okay, let me do some cancellation of that.
Jim Cramer, as always, a pleasure. Thank you so much for joining us here on Closing Bell. Don't forget to catch more of Jim tonight, 6 p.m. on Mad Money. Joining us now to discuss things further, Neil Ferguson, who's out with an op-ed in the Wall Street Journal today. It said, quote, network effects multiply a viral threat. Detailed how coronavirus is spreading faster than most Americans realize. He joins us now. He's, of course, senior fellow at the Hoover Institute. Neil, good to see you. Thanks so much for joining us. I guess the first question is your take on where we are on the scale of acceptance of how serious this virus is, and whether there's a lot more realization of bad news of the reality to come.
Well, the answer, Wilfred, is that we don't know where we are because the United States is lagging behind on testing to see how many people actually have got the COVID-19 disease. Now, the indications are that the United States should be as exposed as almost any country to infection from China. That's one of the things that the network scientists at Northeastern University have shown, and I quoted that in my Wall Street Journal piece. We are very integrated, the United States, and particularly the West Coast, into China. And so a lot of people came here from China in January and even into February. The probability is that we don't have hundreds of people with the virus. It's more likely thousands and, in fact, plausibly tens of thousands. So we still don't know that, and we won't know it for possibly weeks because there has been such a shortfall in testing. But everything we know about network science and epidemiology tells us that it's highly likely that some parts of the United States will have a South Korean, if not an Italian-style experience. And so it's very early in the game in the United States, but you have to look at what's happening in those countries and project forward a few weeks and imagine the United States in that situation. Anybody who's not doing that is living in the same box that President Trump is in, as Jim Cramer just mentioned, telling themselves, oh, it's no worse than the flu, it's just going to be the flu. That actually is completely wrong because the mortality rate is likely to be significantly higher for the flu, and we don't have the kind of herd immunity that we have to influenza. We don't have the kind of vaccinations that we have for influenza. This is a new coronavirus. It is not the flu, and therefore its impact, as we've seen in the rest of the world, is likely to be really quite considerable, particularly for elderly people.
Yeah, you mentioned the president's response, Neil. It's something I wanted to ask you because I know in all of your work as a historian and an author, you've looked really closely at leadership, and you've said very positive things about President Trump in the past. So what do you think is the disconnect here between what we're getting from the administration, what we're seeing in the markets, and what the truth actually is?
The test of any president is the crisis. And what's been a striking feature of the Trump administration has been that actually the crisis took until the year of his re-election to happen. If you look back, let's just take the presidency of George W. Bush. You can see two quite different effects. 9/11, which was a huge shock, in some ways comparable to the shock of COVID-19 led President Bush to show his greatest strength, actually. The response that he gave, defiance, leadership, vengefulness, resonated with the American public and helped the U.S. overcome that shock. It also made him very popular. But when President Bush was hit by the financial crisis in 2008, he looked clueless and his popularity imploded. Luckily for him, he wasn't up for re-election because he'd served 2 terms. Or look at his handling of Katrina, which happened in 2005 after he'd secured a second term. If he'd flunked Katrina the year before, if that hurricane had struck New Orleans 2004, he might have been a one-term president. I worry that President Trump has got on the wrong side of this, that the line he's taking, tweeted out again today, that it's just another influenza, is going to come back to haunt him in this election year. And I'm afraid it's just not in line with the science of what an epidemic like this, indeed a pandemic, which it is in all but name, does, not just in terms of mortality and sickness, but also in terms of the effects that it has on public confidence. And I think when you look at what's happening, not only in Asian economies that have been affected, but also in Europe, you see that the effect of consumer confidence tanking is really very profound economically.
So Neil, what about President Xi Jinping then? I mean, to what extent? I know we don't get very trustworthy opinion polls coming out of China, but to what extent would opinion in his leadership have fallen? And where do you stand on how big the economic impact is going to be on China?
Well, the economic shock was very great indeed, as you could see in the PMIs, really unprecedented declines in economic activity because of the quarantine measures that had to be imposed on Hubei and indeed the restrictions on movement in China as a whole. The line that they're now taking in Beijing is that we're getting back to normal. Hubei is going back to normal. It's early to be doing that, and there is a significant risk that you get a second wave of infections. But I think what's happened is that China's leadership bungled this in the first phase, really denying that there was a crisis until it was very far advanced in Wuhan and Hubei province. But then, because they have a one-party totalitarian regime, they were able to impose the most drastic quarantine that I think there has ever been in human history. What I don't think is going to happen is that Western democratic governments are going to be able to replicate that. Even although they're trying in Italy, it's very hard for a democracy to do what they did in China. So I think the big question, which, as I said, is still in the realm of the unknowns, is how significant a problem is there going to be, not just in Washington state, in California, but potentially in New York, and indeed in other states that already are showing signs of having the beginnings of that exponential growth in confirmed cases that we've seen in so many other countries. If you get something like South Korea or Italy, it's very difficult for the United States to act like Xi Jinping and quarantine a state. And that, I think, means that the response in democracies is likely to be less drastic and therefore less effective than the response we saw in China.
Neil Ferguson, as always, thank you very much.
My pleasure, Wilfred.
And don't forget, tonight, tune in 7 p.m. Eastern Time, a special Markets in Turmoil. Again, crucial viewing amid this crazy volatility.
Let's go back to Mike Santoli for the third dashboard of the day. Mike.
Yes, so I wanted to zoom in on a couple of sectors of the market or styles of investing. Take a look at the Invesco Buyback Achievers ETF compared to the S&P 500 itself. This is only over 6 months. You see really this vertical move down, vast underperformance for the buybacks. Like now, one of the things that kept the buyback story afloat, of course, was corporate debt markets being in good shape. Now, you'd have a lot of financials in this buyback ETF as well. But that's a theme that seems to have been derailed, even if perhaps it was over-credited for its force on the way up in the bull market. Take a look, too, at the transports. We did kind of glimpse those earlier, but this I like goes back to 2015. We are at levels on the Dow Transportation Average we first reached 6 years ago. So it's not just that, oh, we've kind of hit the skids in the market and the tariffs and all the rest of it. You have to basically, you're down on a 6-year basis here, a 5-year basis, and you even have to go back further to 2014. FedEx down to levels seen 6.5 years ago. So clearly, you've really stripped away a lot of expectations for what global growth can produce for this sector. Is it enough? We simply don't know. You have overshoots to the downside as well as the upside in markets.
Mike, thanks very much for that. We will dive into that analysis in a moment. But first of all, breaking news. Steve Leisman's got it for us on the Fed. Steve.
Thanks very much. Well, 6 financial regulators, including the Federal Reserve, the FDIC, the control of the currency, urging some regulatory relief or supervisory relief for banks, for businesses and credits affected by the coronavirus. Regulators say banks should work with their customers in affected communities and to basically talk to them and try to work things out over time. This is very similar, Wilf, to the kind of guidance that we get in an area after a hurricane or other natural disaster, something we talked about could be coming from the regulators a couple weeks ago, and now they're out with this saying work with your borrowers and work with supervisors to try to get over the hump of whatever credit problems might ensue from the coronavirus. Sarah?
But Steve, bank stocks, I can't remember off the top of my head, Bank of America was down 15% today. It was down close to 40% from its February peak. Is this essentially saying banks should take the hit in the short term?
No, here's what it's saying.
The government's going to help.
You've seen these before. They have done this many times before, and you've seen these, where what they say is if a borrower's having trouble making a payment because of the virus that's out there, or in other cases of the hurricane, the supervisors are not going to swoop in and penalize you for not taking action on that bad credit that's in place there. This is a situation where they're saying we're going to provide supervisory relief or supervisory oversight. Where we're going to say, okay, you guys, that is okay for now. I mean, if we get a year from now and it's still a bad credit, we're going to penalize you, but we're not going to do it now.
All I would say on that, Steve, I totally get your point. Is like that kind of expectation sort of goes without saying. It's not like this is a groundbreaking shift in support. Not that you're framing it that way anyway. In a way that I think markets are waiting and looking to hear from as to whether we actually get genuine help from the government to say we will make sure these companies don't need to let the banks down.
Well,
if you see what I mean.
Is a very different story, Wilf, and you and many other people, including members of the Federal Reserve, are waiting for that from the fiscal side. The Fed here doing what it can do, and I would just offer, if it didn't need saying, I don't think they would say it. Apparently, this is an important piece of the whole regulatory framework for them to step forward and say, don't worry about this.
I think the Fed is in its crisis playbook here, and the federal government is not. Is that what's happening?
I think if you were to measure who is further down the line of thinking this is important and they need to act, certainly the Federal Reserve is taking substantial actions. And as you know, Sarah, they're expected to take much more substantial actions.
Steve, thank you.
Pleasure.
Our next guest says a credit crisis is more likely to trigger a global recession than the current stock market meltdown. Joining us now is Nouriel Roubini, chairman of Roubini Macro Associates and professor of economics at NYU's Stern School of Business. Nice to see you.
Great seeing you.
What are you worried about with the credit market?
Well, the stock market has a wealth effect, but since there is a massive amount of inequality, even a 20% fall in the market is not going to lead to a recession, while I think that the seizure of the credit markets has a much more severe impact on the economy. You saw what happened, in 2016 or 2018. We have leveraged loans, we have CLOs, we have $1 trillion of fallen angels in high grade, and we have all the junk bonds in high yield. In 16, spreads went from 300 to 900 in a matter of a month. If they'd stayed there for 6 months, the Fed believed they will have a recession. This time around is worse because at that time, first of all, you had only a growth fear. Right now about China, US, right now it's much more serious. China is going down, the rest of Europe, US is going to go down. Secondly, it's not just the oil market. At that time, oil went to 30. Right now it's below 30. And it's not just oil, it's all the service sector is highly leveraged. It's going to be in trouble. There is more debt. You have all the situation of SMEs and households that are illiquid but solvent. But if they don't get debt relief, they're going to be in trouble. And we've had 3 more years of increasing debt and leverage in the system and the corporate sector. And compared to 16, the room for the policy response is much less than before. We're running out of bullets. So you put it all together, is much worse than what happened in the first quarter of 16 or the fourth quarter of 18. It's going to be much worse. And the trigger for the recession is going to be the stock market, but the credit crisis. And we're in the beginning of a complete seizure of credit market. There is no issuance in the primary market of leverage loans, of CLOs, of high yield or high grade. It's totally shut down.
So worse than 2016, you're saying?
Much worse.
Will it be as bad as 2008? What level of recession are you now expecting?
Well, first of all, I expect there's going to be a recession because Q1 growth in the world will be for sure negative, given you have negative growth in China, in Japan, in Korea, in Italy, and US will have barely 1% growth, and the Eurozone closer to zero. In the second quarter, given what has happened in China, you're going to have a spread of the contagion to Europe and to the United States. The numbers are fudged down because we're not testing. We know that in the countries where we're testing, the numbers are huge, like in Italy and Korea. Why in the US they are so low and you have a high mortality rate? Because we're not testing. Probably we have already 10,000 cases. So in the second quarter, if you have what happens in China, in Europe and United States, you'll have the same situation of a severe economic downturn in the second quarter. So first quarter because of China, second quarter because of US and Europe. And probably in US and Europe it's going to be worse because China had draconian Big Brother society types of quarantine that we're not going to see in US or in Europe. So most likely in China took 3 months to stop and reach a peak of the contagion. In Europe and US could take 2 quarters, and 2 quarters means you'll have recession in Q1, in Q2, and Q3. And it takes only 2 quarters for having a global recession. So we'll have for sure a global recession. The question is how severe it's going to be.
Nobody's talking about a credit crisis at this point yet, Nouriel. Yes, we've seen a big move, but I mean, what I hear from people is it's not panic, it's just dislocation. There is price discovery. You know, this is an early move, and a lot of it today was energy related.
Well, in 2016, it started as energy, but in a matter of a few weeks, you had contagion from energy to the rest of the high yield. Why? Because when you take losses on energy, you have to cover yourself on the rest of the high yield if you're an investor. And this time around, the shock is not just on energy. You have all the high leverage firms in the corporate sector, especially in services, going down. So there is a fundamental reason why the entire high yield should go down. And in this case, it started from high yield, then leverage loans, then CLOs, then it goes even to high grade where you have $1 trillion of fallen angels, of firms that used to be high grade, but now at the borderline, they're going to be downgraded to below investment grade. And then it's going to go from there to emerging markets, local currency, foreign currency. As this movie has happened before, the difference, I said, there are 5 differences compared to 16, is much worse today than 16. We're not yet in the debt crisis, but we're at the beginning of a debt crisis. It's the beginning. There's seizure in the market is shut down. Nobody can issue, not even the high grade folks. So if this is not a crisis or a beginning of a crisis,
this is why they
what
call
it
you
is.
Dr. Doom.
No, it's not Dr. Doom. It's not Dr. Doom. It's Dr. Realist. I mean, I'm speaking about what's happening. I'm not speaking about something hypothetical. What's doomish about it is the reality of what's happening right now. Let's not use stereotypes, Dr. Doom. It's silly.
No, sure. Why do you say that the room for policy response is less now than 2016 when we had Fed funds rate was at under 0.5% then, now we're at 1%. And, we have the same tools as then. Obviously, though, the rest of the world perhaps in a different spot.
Well, the policy rate is almost the same here as before. In the Eurozone in Japan, the policy rates are already
1%
very...
now. It was under 0.5% in early 2016.
Yeah. So we're going to use that one. We might use it actually by another 50 basis points by March 18.
Right?
And
They've
things
been
are going to
taking
start
over,
to be bad only then. During the global financial crisis, we were at 650 and went all the way down to 0. And then we had to do forward guidance and then QE and then credit easing and other things like all the things we did with all the unconventional liquidity things. This time around the world, the policy headroom is more limited than before compared to the global financial crisis. That's a fact, and we know. And we'll see once we go to 0 whether they want to do QE or whether they want to do more convention. By the way, given the supply shock and its partly demand, we know that monetary policy alone is not going to be sufficient. You need massive fiscal stimulus. Take the United States, let alone the rest of the world. There is gridlock. The administration might want a tax cut or a payroll tax cut, and Democrats are going to say, fine, we'll do it if you raise the taxes on the corporate and the rich. They're going to pass it in the House. It's not going to pass in the Senate. The gridlock. Why would the Democrats give this gift to Trump on election year? They're not going to do it, and this growth implies that any fiscal stimulus in the U.S. is going to be tiny compared to what's desirable. People now start to talk about coordination between monetary and fiscal policy. Stan Fisher, Ben Bernanke, this morning, the Redalio on the FT. What does it mean? It means helicopter drop of money. That's a term, right, for helicopter drop of money. You need fiscal policy, and then you have to monetize in the primary market. How likely is that's going to happen, that you have a fiscal stimulus that's going to be immediately monetized? It's maybe the right thing to do, but it's not going to happen. It's not going to happen.
If the S&P 500 down 18% or so from its highs, you think further to go?
Yeah, further to go. A typical recession, the stock market goes down 30 to 40%. During the global financial crisis, went down by at least 60%. Of course, it's not going to be a linear down because as things get worse, tonight the Fed might actually take some action overnight, not cutting rate, but maybe providing more liberal liquidity or extending the purchase of T-bills from April until the end of the year, or ease the discount window, or create one of these term auction facilities like they did in 2008. I'm sure they have to do something overnight. What they just announced right now with forbearance for the banks is not going to be enough. So the market can rally for a day or two. Then things get worse because the fundamental implies that in the next few weeks, the number of cases is going to explode. That's the fundamental. People are going to panic. And then you do it incrementally more, and there'll be a talk about the little fiscal stimulus, $50 billion, what's that spare change, $100 million, not enough, and so on. And therefore, things are going to get worse, and the policy response is going to be less than desirable and optimal. Therefore, the market goes down 30% or more before they bottom out. The trend is going to be down, and it's going to be a zigzag. It's not going to be linear, but the trend is down. It's not up. We have not reached the bottom based on the fundamentals, and the policy response is not sufficient. So if you extrapolate, it has to get worse before it gets better.
Do you think negative rates are possible in the U.S.?
I think that the Fed, when they're going to do their Fed review, they're going to say, as they have said, yes to zero rate, yes to QE, yes to forward guidance. We don't want to go negative for a bunch of reasons. Some people within the Fed favor, like in Japan, a yield curve control, zero rates on the long end, like Leo Bryan. Some people like Rosenberg are talking about buying private assets like stocks and so on. I don't think that's politically feasible. You have to pass legislation. So you'll have a bunch of things to do, of course, including QE, but it's going to occur too late, too slowly, and it's not going to be sufficient because you need the fiscal side to be big, and then the monetary is going to finance it, and we're not going to get a big fiscal stimulus. You need at least a 1% of GDP or maybe more of a fiscal stimulus. What is the chance we get that one before the election? I would say close to zero. $200 billion? No way it's going to happen.
I guess let's see what the market does. Maybe they can force the hand like we've seen in the past. Nouriel, thank you. Good to see you.
Good talking.
Nouriel Rubini
prefers the title now, Dr. Realist.
Dr. Realist.
We won't use Dr. Doom, but you must accept you're not Dr. Optimist as well.
I'm Dr. Realist.
Okay.
There are sometimes to be optimist, there are times to be pessimist.
We need to
right
see
now is
more
the time.
It's nice to end with a smile, regardless.
Yeah.
Anyway, Nouriel, thanks so much for joining us. Crazy moves. So let's have a check in there on the Dow, how we finished down 7.8%. Dr. Realist striking the right tone if we have repeats of today. Walmart even falling into the red as well at the close. It had been green for most of the session, but all 30 stocks negative and plenty there at the bottom of double-digit decliners, about 7.
A 2,000-point loss for the Dow, worst day since the financial crisis. Let's get the latest details on how the White House is responding to the coronavirus outbreak and the market meltdown. Eamon Jabbers with us from Washington. Eamon.
Well, White House officials tell me that meeting with the president and his economic team did begin around 4:15. They told me it was underway here, so that is ongoing. The president is set to be presented with some options for how to respond economically to the coronavirus. Not clear where the White House is going to land, and aides were careful to caution me today to say it's not necessarily guaranteed the president is simply going to pick from a menu of options and make a decision today. We will wait and see what happens when they emerge from that meeting to see if any direction is being set out upon here from the White House. Meanwhile, as the president's making those decisions, congressmen who have been in contact with the president over the past 2 business days are now being self-quarantined. Congressman Matt Gaetz, who was with the president on Air Force One this afternoon, has announced that because he came in contact with someone who potentially had the coronavirus, he is entering self-quarantine. That self-quarantine began after Gaetz got off Air Force One with the president this afternoon. Congressman Doug Collins was with the president on Friday in Atlanta at the CDC. He also now under self-quarantine. Neither congressman, we are told, has any symptoms of coronavirus, but that's sort of what's swirling in the president's worldview as he sits down to have this meeting today. People he's been in contact with are now under self-quarantine. And guys, we're expecting a series of meetings later on this week. Health insurance executives are here tomorrow to meet with Vice President Pence. And then on Wednesday, Wall Street CEOs will be here at the White House to meet with the President of the United States. All of that formulating a response from the private sector in terms of what to do on coronavirus and what kind of help they may need from the federal government, guys. Back over to you.
So, Eamon, as the market was plummeting today, the president was tweeting. And this tweet in particular, I got a lot of commentary about. So last year, the president says 37,000 Americans died from the common flu. It averages between 27,000 and 70,000 per year. Nothing is shut down. life and the economy go on. At this moment, there are 546 confirmed cases of coronavirus, 22 deaths. Think about that. In other words, continuing, I think, to downplay the severity of COVID-19, the fears in the market, the fears from ordinary Americans. I mean, what is anyone telling him, Eamon, that is completely disconnected with what the market is telling us and what we're hearing from healthcare professionals?
Look, I tried to get a question to the president in as he came into the White House this afternoon. He did not stop to talk to reporters about the market sell-off today. He did bring Brian Urlacher, the former Chicago Bears player, into the residence with him. So he's having a social visit here just before the meeting with the economic team. And look, the president's getting a lot of advice. He sees what's on television. You talk to White House aides, they say, you just don't even need to brief the president on what's happening in the market because he sees it in real time. And I think clearly the impetus behind that tweet is he doesn't want to panic. He wants to put all this in context. But the danger politically is that you do look potentially out of touch, and you look like you're not taking this with a sense of seriousness that it deserves. The president was in Florida today having a fundraiser, for example, not here at the White House until this afternoon. So all those optics matter for a White House and for a presidency. And of course, as we know, these kinds of emergencies, public emergencies and financial emergencies can be life or death stakes for politicians politically in the White House.
Eamon Javers. Eamon, thank you.
You bet.
Take a look at shares of Stitch Fix after hours, plunging on earnings. Kate Rogers with the story. Kate.
Hey, Sarah, that's right. Stitch Fix down just about 37% right now. That's on a really mixed quarter here for Q2. EPS a beat 11 cents versus estimates of 6 cents. Revenues, though, a miss here, $451.8 million versus estimates of $452.5. Now, Q3 guidance here on revenues is a bit lighter than expected. The company's saying they believe there's heightened promotional activity across retail and that clients wound up spending less per fix in the current quarter on average, resulting in lower order values than the company had anticipated. They also said they have 3.5 million active clients. That number is up 17% year over year. And also just finally mentioning coronavirus is a fluid situation that they're monitoring, but right now no material impact on their business. That conference call kicks off around 5 p.m. and we'll bring anything else we get. Back over to you.
Can we go there?
Kate Rogers, Kate, thanks. Down 37%, Mike, gives us a taste. I mean, they didn't blame coronavirus, but It gives us a taste of what the action is going to be around earnings season.
Yes, maybe an extreme example, I would imagine, but this is not the kind of market where you have kind of a show-me story stock that hasn't yet proved it can sustainably, grow into its expectations, going to disappoint like that.
Just want to bring some other news. The Italian Prime Minister just giving a live address moments ago and announcing that the restriction zone will be extended to cover the entire country. No longer just a red zone in the north of Italy, in the Lombardy and surrounding region as it had been. The entire country is now quarantined in that restriction zone. I mean, Mike, we talked earlier in the show, clearly the oil news was a huge part of the story over the weekend. I think seeing a Western democracy move to the sorts of draconian measures that we'd seen in China had also been a big piece of news over the weekend that surprised the market. The entire country, that is quite astonishing.
Right, absolutely. And also the fact that everybody here knows in the U.S. cases are going to go up. We're just on the front end of this spread. But the idea that it could get out of hand and that we're going to be living with this drumbeat for a while, I think is a significant thing. Now, at some point, I keep saying the market is just going to overshoot to the downside to price in a pretty dire scenario that might be a little bit worse than the probable one. So we just don't know where we are in that process right now because we don't have enough numbers in terms of tests to draw the curve and to say we know what we're looking for in terms of the numbers rolling over.
By the way, the Italian stock market today dropping 11% on that, the idea of that lost economic activity.
Yeah, but to that point, I mean, the Dow Jones is down 8%.
Yeah,
so,
I guess so.
I mean, just enormous moves all around. And just whilst we bring that up, China was only down 3%. Again, China stands out as really not having fallen anywhere near the level you might expect given the likely economic impact. But again, we've talked about all sorts of sectors that have been hit, banks and energy stocks the most. And clearly, if you're looking down a whole country, it's understandable why those sectors have been suffering.
Makes other European countries also probably rethink those open borders.
I'm sure it does. And just to come back to as well, we talked about the way in which U.S. banks have been hit. Deutsche Bank, since its February high, fell 46%, I think it was, to the close. Now, it had a very strong run December into January, February before that, but it closed at or around all-time lows. So again, similar types of movers in European markets, similar types of sectors are taking the brunt of this, some extraordinary moves globally all round. Let's check in on some of the travel stocks, which, as we mentioned, have been in the eye of the storm. Travel websites down more than 5%. Trivago getting hit the hardest, down 17%. As you can see there, bookings, Expedia, TripAdvisor all down over 5%. Our next guest says this hit to travel could also hurt ad-driven tech businesses like Facebook and Google. Laura Martin joins us now. She's a media internet analyst at Needham. Thanks so much for joining us, Laura. So talk us through it. The likes of Facebook and Google, perhaps more linked, do you think, to the coronavirus travel restrictions than so far has been priced into the stocks?
Yeah, so travel advertising, this is their peak period for advertising in anticipation of people traveling during the summertime. 70% of all travel advertising is online, and 70% of that is in search. So Google is the big loser there, both in March and in the June quarter. We took numbers down. But Facebook is not only exposed to travel, it's also exposed to CPG and retail and entertainment, like the James Bond film being pushed off lowers advertising by 50 million, just that film being pushed from sort of near term to November. So that's about those four categories that are already showing lower advertising demand are 45% of total digital advertising in the U.S. and 30% globally.
Do you think it's already in the stocks, Laura?
No, because I think people are underestimating that when you have a revenue downdraft, they are 70% margin dollars. So there's a bigger profitability hit than people are thinking. And you probably saw that Microsoft, Facebook, Google are doing the kind and humanitarian thing. They are going to pay all of their hourly workers who aren't coming to work anymore because they've sent everybody home. So that's going to be great for the local economy, but it's going to really blow up their income statements even more than the downdraft in their revenue.
Laura, when you assess these stocks that you've covered for so long and know so well, do you think about the price to earnings multiple relative to the rest of the market? And do you adjust what's reasonable at moments like now when fear is spiking? Traditionally, these guys have had higher multiples, but when things are calm, that can be argued to be justified because their growth is high. Does that go out of the window at a time like now, or does it still apply?
No, it sort of goes out the window right now because we don't know where the bottom is. You know, when we get to a bottom, when this coronavirus numbers stabilize either in the U.S. or China or offshore, then we can look at where the bottom is. And at that point, we can assess what the corrections have been and start putting money back to work. But right now, there's so much uncertainty about the damage that coronavirus is going to do to consumer demand and to the market access, like, can you raise any money in the equity or debt markets right now? And for how long are they is the window closed? That we have to see where those relative valuations are once it bottoms and consumer demand starts returning.
Is there any name that's relatively insulated from this? For Twitter, I didn't hear you mention, for instance.
No, I would stay away from all ad-driven stocks, which are fixed cost businesses with 70% margins. We like Peloton because people aren't going to a gym as coronavirus fears escalate. And it's a subscription business, and they have 1% churn. So once you get one of these Peloton bikes for any reason, even if it's to not go to the gym for a couple months, you don't ever get off of it. So we really like Peloton as a defensive play in this market.
But are you going to go out and buy a Peloton if you don't want to go to the gym? Is that what's happening?
Well, I think people in our demo might be.
There we go.
I mean, we did see a move in the stock on that.
Defense, well, it's down today, though. But Laura, thank you so much for that.
My pleasure.
Let's send it back to Mike for his final dashboard of the day. Mike, what do you want?
Yes, markets kind of fully in the mode of trying to handicap just exactly how much of an economic slowdown we get globally. This is the Goldman Sachs current activity indicator, so it's meant to be a leading indicator of global GDP. Keep in mind, not just U.S., but global. In February, this is as of the end of February, it was barely above the zero line, around 0.5%. And when we're talking about global, that's a steep slowdown. It's, the world grows faster, typically than mature economies like the U.S. So that is basically foretelling a first quarter print for global GDP somewhere under 1%. I guess the question right now is maybe bond markets have adjusted to account for something like this environment, but how long would it have to last at that type of near zero growth level for stock markets to really adjust. That's unclear right now, and I do think this is what a lot of people are focused on right now. We were sort of okay with this idea that we had a pause, but if it's something longer than that, then we might have to end with it.
To the global growth question, Mike, I think we should come back to this announcement from Italy, because the Italian Prime Minister says, on top of what we said earlier, that the whole country is now in quarantine. All Italians should stay home, think of the common good and play their part to combat this coronavirus, cancelling all public gatherings, all sports matches. I mean, the market was down 7 or 8% today, and you look at that and say, what level of news headline do we need to create another shock to the downside? That's pretty extraordinary, and it will also raise that question, what will other Eurozone leaders do if they start to see numbers pick up and they don't want to be blamed for not being cautious enough? I mean, this is an astonishing move.
We're going to have to interpret to see if that's going to be an outlier response or not, and how do we guess that? It's very difficult to guess that. Now, I do know there's a lot of commentary that Italy has the oldest population in Europe, and it does disproportionately. The deaths have all been 60 and over in Italy. So I do think that maybe that has something to do with it, but it's certainly a little bit frightening.
I get that they have an aging population, but I'm afraid so does France, Germany, the UK, and the US. I mean, it's not like the demographics are attractive in any of those places. I do think the other theme that has come out from the commentary that we have seen as well from Prime Minister Johnson and others is to try and ease the pressure on health services in the short term and hope that they can manage it that way. But so far, only Italy taking this action, and clearly their numbers are much worse as well. So far.
When's that ECB meeting? On Thursday? That's going to be a tough one.
I mean, but to that point, we're saying the Fed perhaps might announce more overnight or whatever. What on earth is the ECB going to announce? What can they announce? It's almost lose-lose. Deutsche Bank's collapsed 46% in the last month. If we go negative rates, that's going to go further.
There's always tools in that toolbox.
I'm not sure there is.
We'll see if she can come up with something.
She'd magic something up from nowhere, perhaps, but I'm not sure elsewhere. Let's have a look at how we finish the day. On Wall Street, as we've said already, record decline in points for the Dow ever. In percentage terms, both the Dow and the S&P worst declines since various dates in 2008. 7.8% on the Dow, 7.6% on the S&P 500, 7.3% on the NASDAQ.
Incredible numbers. Will tomorrow bring more pain or relief rally? Bob Bassani is looking at some ETFs that may give investors clues.
Yeah, unfortunately, we don't have a lot of direction. Futures are still trading here. Just look at the S&P 500. SPY here still trades, closed at 274.23. I see it right now. Last trade at 274, a little bit below that, 274 right now here. So let's call that relatively unchanged. Diamonds, Dow Jones Industrial Average is the ETF for that. Closed at 238.72, now trading at 238.20. Again, very, very modest decline from the 4 o'clock close, and the triple Q 193.57 is where that changed hands last at 4 o'clock Eastern time. You see there 193.30. So modest, very modest decline so far. I agree with you, Wilf. I think these comments from the Italian the heads of state in Italy are absolutely remarkable at this point, and still not seeing a dramatic move, though, here.
Do you think that was priced into the market today, that we're expecting that to extend?
No, I don't, and I think that's quite extraordinary. I agree with your point here. So these are like rolling headlines, and we're trying to get used to all of this on a daily basis. I think the only good news today is we did have that initial shock with the circuit breaker, and it served its purpose. The purpose was not to change the headlines. The purpose was to slow the market down for 15 minutes, gather liquidity, and it did that, and the market did lift, even though we closed at the ends of the lows at the end of the day.
So, Mike, what are we watching overnight?
Kind of reminded of Michael Hartnett at B of A has a saying he always goes back to, which is markets panic until policymakers panic. Maybe that's the next thing we're actually trying to hook ourselves onto, because over this phase, we've been able to say multiple times.
And it's not going to be the Fed this time, right?
Well, I think partially, but perhaps not all. I think the real policy response people are wondering about is congressional, is fiscal.
What do you look at overnight, Mike? I mean, Asian markets, obviously, but oil price.
Asian markets and obviously yields. I mean, it went unremarked today largely that the Treasury yields did have some lift throughout the day. It's been a real sucker's game to try and call the final buying climax in Treasuries, but that is something to watch because they do trade, more or less throughout.
I think we're going to have to watch for tomorrow. Obviously, we're not going to get a bottom in coronavirus stories, but some kind of indications of massive fiscal stimulus. I think the market would be much more impressed, and not just for consumers. It's not the consumer doesn't have money. The consumers have money. They're scared. Corporations need assistance as well, and I think that might help provide some kind of
at least short-term.
Well, we're all going to be watching over the next hour Fast Money, which is about to start. Brian Sullivan here with us now, Brian, where really the heart of it all today was that shocking oil move, down what, 25%?
Yeah, you guys have noted, I mean, the biggest one-day slide since 1991. But again, not to belittle it, or belabor it, it's people say, well, who cares about oil? It's good, right? Gas prices are cheaper. The problem, of course, as I know you guys have talked about, and of course, Wilf, you cover the banks, it's really a debt and a credit story. It's an oil story as well. Oil, a small part of the stock market, but a much larger part of the credit markets.
Absolutely, Brian. I mean, it could become a debt and a credit story. I think that's the key question for the banks. They've fallen sharply like the oil companies, but as yet, unclear whether they warrant that level of fall or whether we'll see those types of debt issues. Either way, down sharply today. And Brian, we know you'll have all of the analysis covered. We're out of time here on Closing Bell. Over to you.
Yeah, we'll try to get some rest tonight, guys. We'll see you tomorrow morning. Nice and early, Wilf and Sarah. Thank you very much. All right, everybody, welcome to Fast Money. I am Brian Sullivan, and your traders on this very important night tonight are Tim Seymour, Steve Grasso, Karen Feinerman, and Guy Adami. All right, we're going to get to that in just a second. It was, meantime, a record day on Wall Street, and for many, a day to forget. All three major averages plunging more than 7%. The Dow, the biggest loser, falling 2,013 points. That is not a misquote. That is the largest point drop ever and one of the top 10 biggest declines on a percentage basis ever. The transports crushed, falling nearly 10%, their worst day since all the way back in September of 2001 on 9/11. Obviously, don't need to remind you what happened then. Today's losses fueled by that crude crash that we just discussed. The energy sector having its worst day ever as well. Oil losing roughly a quarter of its value. Crude is now trading just below $31 a barrel. Many oil and gas stocks down 30 and 40% today as the market assesses simply many of these companies' ability to survive in a lower oil priced world. And one more incredible stat for you on this incredible day. Interest rates continue to collapse. The yield on the 10-year Treasury note hitting a new low of nearly 0.3%. Well, following yesterday's sell-off or today's sell-off, S&P 500 stocks have lost a total of $5.7 trillion in market cap just since the record high on February 1st. There is your setup. It was, by any measure, an historic day. Guy Adami, I know you were on Power Lunch as well. Welcome, everybody, on this big day. We are commercial-free, by the way, through the entire hour. And this is a night, Guy, where we don't need to really get complicated. It's a question of what happened and what do we do now? Do you really believe that the drop in oil is what triggered this market today?
Well, it's obviously a big part of it. You can't discount the fact that when crude moves to the extent that it moved, given the moves it already seen, it obviously had a lot to do with it. And that's stoked the fears as well. But again, a lot of this has been in place for quite some time. Bond rates, the bond market shouldn't move like it's moved over the last year and a half. And I'm not saying that today. We've been saying that for quite some time. The volatility in the bond market was striking. Nobody really talked about it because it's not equities. If we had half that kind of equity volatility, it would be front page news every day. Currency is the same thing. Tim speaks to that all the time. Now it's finding its way into the equity market after a long period of time. I happen to think, as painful as this is really a good thing. The market needs this. I'm not suggesting it's over. I think you know when it's over, and this is just my opinion, when you see some big either hedge fund or derivatives book or some sort of bank with a huge derivatives options plays, when they blow up. When that happens, we're close. It hasn't happened yet.
I saw some data today, Tim, that in some ways average volume was higher than during the peak of the 2008 collapse. The action was fast and it was violent.
Dollar volume certainly would be based upon the levels we're at in the market. But the velocity of this, pick your asset class, every single one. To the intraday low on the S&P, we were down about 19% in 12 days. Guy mentioned the reference to the dollar being down about 5.2% in 12 days. The yen strengthening, which we all know is kind of this unwind of carry trades. That's part of the dollar's move, by the way. And without getting too lost in that, those are, that yen move is a massive risk off move. That's almost 10% move in the yen in 12 days. So, look, there's different fires going on around the world and in different asset classes, frankly. And I think oil over the weekend was the latest black swan in the middle of, what might be a group of fowl. There is a credit dynamic that is emerging out of the energy space that we all knew was there. And if you talk to credit traders in energy and in high yield, they'll tell you that actually, where they're seeing the market right now is inside of the lows of 2018 December and more likely nearing the lows on spreads right now of 2015.
And we'll get to more on energy with Mike Bradley at TPH, one of the best, if not the best in the business. But Steve, I want to start off with you. And we had a circuit breaker hit. Right. It fell 7%. I think it was 3 minutes after the open on the S&P 500. Stopped for 15 minutes. What was that like? You're on the floor. What was that
Panicky.
like?
It's not every day you deal with a circuit breaker. And
we had it 3 times in 20 years or something like that?
3 times. And when you have it telegraphed, where last night we're limit down the futures, that was a big deal. And everyone was waiting for us to get dropped to the next level, which was down 13%. So I think we're starting to see shades of panic. But I'd rather have this panic in the oil market than in the financial markets, in the banks, if that makes any sense.
Didn't we have that today a little bit?
You had it, but there's not a balance sheet panic. There's a stock price panic, and I think those two things are completely different.
Yeah, because, and I think we have a graphic on this. Goldman Sachs put out a note late today that I got, and it's basically energy's exposure to the banks, and it's small. I think Citigroup was the highest at about 3%. You've got Bank of America at about 2%. So on an absolute basis, Karen, we're talking about a fairly small portion of the balance sheet.
So I don't think that's really what was going on today. I mean, the market was down, so of course everything would be down. I don't think it was oil. I think it was more this idea of rates, of course, that always, is difficult for the banks, but this idea of a recession and credit quality. And what does that mean if we have a slowdown? What does that mean to their entire book of lending? Forget oil. The rest of their lending. If you look, Bank of America, I think, is maybe among the hardest hit. They have a very big consumer book. So that's what I think, aside from the market, aside from rates, aside from oil, which really is the last one, the smallest element of the move.
Because take us into that, because I think this is a really important point to make, because it's not move today. It's about what happens going forward. There's the data. Citigroup, 3.2% of their order book, according to Goldman Sachs. Wells Fargo, 1.5%. Those are small numbers relatively, but we're still talking $15 and $16 billion in the case of Citigroup or maybe JP Morgan Chase. And so is the idea, Karen, what you're talking about, if those things start to suffer, the chance of them lending money to businesses, giving you a mortgage, all that stuff starts to shrink a bit.
Not because of the oil exposure, I don't think. Because of the rest of the book is so much bigger that, if you're going to have businesses that are really starting to have trouble, that's, I know JP Morgan, all the banks want to be, they want to be a good partner, but at some point, you don't want to extend credit that you don't think you're going to get back. So that's what I think was weighing a lot, plus rates and a market that was down.
I think today was the big fear day, right? I mean, everyone felt afraid. You had so much of that set up last night when you're watching the futures limit down. And then when you hear Governor Cuomo, though, I think he put it in perspective rather well when he said we're battling more fear than the virus. And I think we're not scientists, we're not MDs, but to me it seems like the market's trying to factor all of this in, and I don't know where the chips finally fall, but it seems a little overdone to me.
Well, listen, Steve, fine, but we just had, you heard Wilf and Sarah say it, that the Prime Minister of Italy is trying to shut down the entire nation.
Right. I think
it's the ninth biggest economy in the world.
So let me just real quick. So I think what Wilf is saying, though, too, is that countries are trying to outdo each other with what they're shutting down. It's the same thing with S&P 500 companies. They're shutting down visitors. They're shutting down cafeterias. And if you don't shut down, you seem like you're being cavalier, and God forbid something happens and you're to blame for it.
Yeah.
So I think we're in a race to shut down the world
fair,
right now.
Fair enough, but that's not for us to judge here. Our job here is to analyze the economic backdrop, Guy Dami, and say, if we see a significant reduction in travel, driving, commuting to work, an economic slowdown, we have no idea what growth rates are going to be, if we have growth, and what corporate earnings are going to be. And maybe this is a stock market that reflected the idea that simply they don't know anything.
Yeah, I hear what Steve is saying, 100%. And we have a lot of time that, which is good. I mean, I think the coronavirus, a lot of people say it's the cause. That's fine. Everybody's entitled. I think it's just was sort of the final match on what has been a tinderbox, and that set it off. With that said, the S&P 500, I think at today's close is down 19 or so % from the recent all-time high. It's a pretty big number. People will say the market's cheaper now. That might be true. I'd push back and say I can make an argument, and I'm not, again, I don't know this, but I can make an argument that stocks might actually be more expensive today than they were at the all-time high.
Because we don't know any of the multiples.
How can you possibly, now I'll say this quickly, 73% of this economy is driven by people buying things, going places. People are not going places. Listen, I want to go to my conference in Chicago at the end of the month. It got canceled. That's real. That's happening. So I don't think we can sit here and say, I don't think anybody's trying to do it, but we have no idea what's going to happen to earnings.
And 165, 166, which is where we were last year and where consensus is. I mean, first of all, I think we're lucky and I'll leave it ultimately to the strategists that are making a call on S&P earnings, but you can't tell me we're going to grow 3 or 4% in a revised downward. I mean, we're talking about a major contract.
Tim, let me ask, do you think we contract?
Yes, I do think we contract. And that's even in the construct that we're in now. So, Guy, we're all talking about the lack of uncertainty about the duration of this. The other thing I bet the market, and I think we're all saying this, what is notable to me, though, despite what's implied on coronavirus here, is that I don't think today's move in the markets felt very coronavirus at all. We weren't really talking about the virus. We weren't talking about politicians around the world. Yes, Italy took northern Italy and basically quarantined it. And yes, New York State and other states are doing dramatic things. Schools are closing. But the market's move was set in motion by OPEC and Saudi, basically playing Russian roulette. And I think Putin's got an ability to play this game longer than the Saudis do. And this is the construct in which the markets came into today. And then it's the credit. And then it's the dynamic that we're all talking about with different asset classes. Yes, Corona, of course. But what was interesting to me about today, as we get deeper into news flow on Coronas, the market wasn't trading on Coronas to me. It just wasn't.
All right, let's talk more now about today's big sell-off. And more importantly, what now? What do we do? Joining us on the CBC Newsline is Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, was today the bottom?
I think it's really close to at least a bottom, Brian. I think to capitalize on a little bit of what Timmy said, the yen's move today was extraordinary. So if you look at the 10-day rate of change on the U.S. dollar-yen relationship, it's worse than it matches the worst of 08. And it happened on actually October 27th of 2008. And obviously that wasn't the low. It was a low. You actually had a significant rally off of that level. So as I wrote last night, the market is set up because of how wild the movement is in the various asset classes. I could look at the VIX, the 10-week rate of change there, matches the worst of 08. Again, not the low, but a low. Same thing with the 10-year note yield, 10-week rate of change, most excessive in history by a long shot, and of course the S&P. So, there has been a significant drop, but it also isn't historically unique.
Connect the dots between what happened in the yen. I mean, people tuning in, we're fast money. We're talking about the stock market, but here we are talking about the yen twice in 7 minutes. What is the yen telling us? What does that mean?
It's just a flight. It's a risk-off trade. So think about the sentiment. When we downgraded on the show, we downgraded the market on January 20th. We have yet to upgrade it because of all the issues that the folks on the desk have talked about. But think back then, the sentiment was so positive. There was no real currency issues. The VIX was as low as it's ever been. The 10-year note yield was just kind of grinding lower, and the S&P was making a new high by about 0.5% every single day. And sentiment was just far too extreme. That's one of the reasons we downgraded. Look, just think of last week. People were thinking the market was going to correct, but they weren't bearish. The movement into these issues suggests that now they're getting bearish. Let me just give you the data. So last week, Investors Intelligence had 41% bulls, which is down pretty significantly from where it was over prior weeks at the new high. But there were only 20% bears. There's still, as of last week, twice as many bulls as bears. In 2011, it was 45% bears, 2016, 40, and 2018, 35. So I think this week is kind of flushing it to the point where you're going to get this wicked reflex rally.
Well, I'd like to see them redo that questionnaire on bull bear today, right now. Steve Grasso, jump in here. So Tony, when you look at this, I get airlines, I get the pressure there, I get the pressure on hotels, I get the pressure all around it, but are we going to make up for it in other segments of the economy? What do you think earnings are going to be? Because the market is a forward-looking price mechanism. What say you on that?
Well, earnings are clearly, I've been below the street for the entire year. I'm at 172. I think the street's at 174 or 175 for this year. I think I'm going to be too high. But it's really this, I'd love to make it a fundamental issue, and credit is always a fundamental issue. But this is a human nature situation, and that's how you create tops on human nature and you create intermediate-term bottoms on human nature, and then the fundamentals shake themselves out. So to put the fundamentals into the intermediate-term bottoming process, human nature gives you the whoosh. We got that. We're down 19%. The kind of oversold condition and asset class volatility creates what is typically a vicious multi-week reflex rally. This has kind of been our playbook for the last couple of weeks. That reflex rally ultimately fails historically because you start to get that negative economic data, that negative corporate earnings revision data, and it's at that demoralizing test of the lows that you want to throw offense aggressively back on the field. So that's our playbook.
Hey, Tony, a quick question just in terms of the other sectors that, so we talked about transports. Retail, if you take this back, and the XRT isn't a perfect measure, but it is certainly one measure of retail. You're back to April 2013, if you drew a line. Is there any part of this that you think is getting, maybe this is a different way of asking the same question, but there's certain things that have been beaten, and they were beaten coming into this. Is this capitulation moment?
I think it is. I mean, I think it is also for banks. I mean, look at the BK, the retailers, the banks, the stocks, all the semis. It's the Philadelphia Semiconductor Index. All of these areas are. I mean, the KBW Bank Stock Index, the BKX, is down 35% since late February, not since like years ago. So this is what, unfortunately, severe whooshes look like, and just to kind of. To put it into a context, Tim, so we can try and get in what it could look like over coming days. In 2011, we had an 18% drop over just a very few days. People forget about that. That was when Greece was going to fail. An 18% drop in a straight line over a few days. My friend Walter Diemer gave some context on that, on how volatile it got then. After that happened in August. After that, you had 7 90% upside days or consecutive 80% upside days. In other words, all of the volume was up. You also had 9 more 90% downside days. In between that whoosh lower in August of 18% and the final low in early October, which was down 19.4. So we're set up for a ramp. Yeah. It could be in the retailers, the banks, the semis, all those areas that nobody in the right mind wants to touch right now. But then you get that demoralizing test of the low, and it's there that our game plan is to get more offensive. Because I frankly don't like
it. Tony, not yet. On the macro market, the advice to the viewers: do not get aggressive yet. Correct?
Well, it depends. Okay, so this is. I mean, if you're a trader,
Tony, I love you, brother. We got to move on. Yes or no?
Okay. No, I'd wait until the test from an investment standpoint.
All right, Tony Dwyer, Canaccord Genuity. Tony, I appreciate that. We are commercial free, but we still got a lot stacked in here. Guy Dami, when I look at the few things that were higher today, auto parts were higher. No idea. Dollar Tree. You know what tends to move up when things slow down in the economy or recessionary? Those types of companies. In your mind, when the data comes out, and sort of I asked Tim this in a backward way as well, are we in, right now, will we go into recession?
Well, now I know we have a lot of time. What causes a recession? So in my world, my crazy world, a stock market sell-off causes a recession. Why? Because people get spooked. They stop spending money. We're down 19%. With this coronavirus, people are absolutely spooked. So are we there yet? No. We're on the cusp of one? Absolutely. But, I don't think a recession causes the stock market sell-off. I'm probably the wrong person to ask. But I'll say this quickly again. I'm with Tim on the coronavirus thing. Go back and look in September when this whole Fed overnight repo thing started. We talked about it on this show. Nobody ever heard the term coronavirus back then. Yields were falling precipitously back then, not like they are now. Gold was going higher back then. So all the warning signs were there. We tried to point some out. It fell in large part on deaf ears because the market went up every single day quickly. To me, the absolute breaking point for me personally was over that weekend when Apple said, you know what, things in China are bad. You know, we're not going to meet our numbers. The stock was at an all-time high on Friday, traded down $6 the next day. Nothing. The following day was making an all-time high. You think that made any sense whatsoever? So as crazy as you think this might be, I would say that was equally nuts.
Well, if you think about something like a Walmart, which was up, eked out a heroic gain today, and certainly has been trading, very much close to all-time highs. And yeah, I get the panic buying, the stocking, the pulling forward, but my view on Walmart is this was an expensive stock 3 weeks ago. It's only a much more expensive stock relative to the market now. We haven't even gotten into a place. Friday, we all universally shrugged off a non-farm payroll that had 275,000 jobs added and a 3.5 unemployment rate because everybody said that may be the last number you're going to see like it. Ultimately, Walmart to me is one of the great conduits of some of that job market being so healthy, and one that would certainly be the first to suffer from it. I think you have to be very careful about chasing these stocks that have been defensive because of the environment related to coronavirus that has made their business model in the short run seem very interesting when in fact they're very reliant on the consumer, and the multiple on the stock is well past its 5-year average. In fact, it's about 25% expensive to its 5-year average.
I just want to talk about the auto parts space for a minute, which I thought was really interesting. I don't know exactly why. I don't know if it's because people think people aren't going to buy new cars, they're going to hang on to their cars longer, or it could be gas prices are going to plummet. People will drive more. Maybe if they're not flying, they'll drive. Not really sure, but also maybe their supply chain is better than some other industries. It is interesting to me though that space, which is very consumer driven, did seem to have a pretty decent day.
I don't know how the rest of you are gauging this, but when I go on the CDC website, and I look last week or a week and a half ago, 1,600 people died from the flu, 80,000 died from the flu a couple of years back. Now, I'm not belittling any of the deaths, but I do think that this is an overreaction because we have no idea where this is going to go. I do agree with Guy. The market wanted to sell off. They wanted to sell off on impeachment. They wanted to sell off on tariffs. They want to sell off on everything.
Well, I think I'm saying the same thing. I mean, I said I don't think the market was really pulling back on Corona today. And ultimately, the question is really, I asked this question, I posed this on Friday, where I said, is the move proportionate to a change in fundamentals? And the other question you ask is, well, where were fundamentals? And were fundamentals at 3389 on the S&P, were they in the right spot? I think we can. Well, I would argue, and I think there was a lot of folks looking at price to sales, EV/EBITDA, price to earnings, and able to draw comparisons to times when the market's been very bubblish. It's not all stocks, but again, I think part of this is where we came from. That's why the velocity of this move is so extraordinary.
Can I just add one more thing?
Yeah, sure.
I think coronavirus actually had a fair amount to do with today for somewhat of a different reason. New York is starting to feel the effects of maybe not coronavirus, but of the reaction to what do we do. New York is the psychological center of the financial markets in the U.S., right? And I cannot help but think that people involved with the financial services industry now feel this is coming to their doorstep, and it feels so much more dangerous than a
hometown overreaction.
I don't know if it's an yeah, maybe. It's
because
a hometown
every trader
reaction.
I know is either now working from home or they're split into teams.
Right. Call it a
you
reaction.
go into work today, you go into work tomorrow. You guys never see
every
each other.
trading desk that
everybody's doing that. Our audience probably doesn't realize
splitting the trading desk just to keep 50% of the people healthy. But when I look at where you're spending the money, yes, the cruise lines, yes, the hotels, yes, the airlines, those are going to be impacted. But there's got to be an overflow that goes into other sectors that somewhat makes up for it because people are not stopping spending completely.
We'll get to that in a second because basically some government agencies are saying maybe you should reconsider taking a cruise. All right, so that major drop in oil fueling the massive sell-off today, or at least a big contributor. Crude down 25%, biggest one-day drop since 1991. The energy stocks, they got, obliterated. I don't know if that's too strong of a word. Probably not. You had Occidental Petroleum losing 52% of its value today. Apache, Diamondback, Marathon Oil losing 40+%. You name it. Let's bring in Mike Bradley of Tudor, Pickering and Holt. He's been on the front lines of this. We've been talking for about 2 years on this debt issue out there, Mike. So tough day to have you on, but we certainly appreciate it. And did the market deserve, a terrible word, I guess, should the market have sold off the way that it did? Did Occidental deserve to lose 52% of its value today?
I don't know. Look, I think the biggest issue with today's market was not only crude oil prices, but the debt markets really came apart today. You're seeing some really high-quality E&P names where the debt was, par 2 days ago, and now it's trading at 60, 70 cents. I think that was the big driver. Illiquidity in debt markets really took some of these equities down, and anybody that has any leverage on the system and anything is questionable, it's just got destroyed today. And so that was the main driver. It's probably been, it feels very much like Q1 of 16 when we saw, high-yield books blow up and debt really fall out of bed. That's what today felt like. It felt like a lot of illiquidity, and it felt like it was less about crude oil and more about just fundamentals, financials, and debt for these guys.
Do you think, we asked this on a macro market level, Mike, I'll just focus on the energy stocks. Do you feel like today was the washout? Nobody seems to agree it is for the macro market, but for the energy stocks, was today the worst it gets?
Yeah, it was pretty bad. Look, we got some of these things are so technically oversold here. But the one thing we would say is that we did not see a lot of guys stepping up to these names today. I think what people are looking at is, okay, is this going to be a 2 or 3 month issue with OPEC and with coronavirus? Or is this going to turn into a 12, 18, 2-year type event? And I just don't think a lot of people right now, are falling either way at this point in time. So I think it was warranted. Probably, is probably oversold today, but I just don't see really many buyers coming into these stocks at this point in time.
Hey, Mike, it's Tim. Again, thank you for joining us. Crazy markets. What does it take to be a hero in terms of doing the balance sheet work and assessing some of these first lien loans? And again, our viewers aren't trading in this stuff, but you are. And at some point, valuations matter and things get kind of, credit can be qualitative. It's also a numbers game. What do you need to see?
We just don't see a lot of people buying these stocks yet on valuation. It really is certainty. And you saw it today. A couple of these E&Ps came out. They cut spending pretty aggressively. And you're going to see them, a couple of these E&Ps are just not going to grow next year. In fact, they're probably going to decline. I think that's what people are wanting to see. They're delivering it, and those stocks outperform. You're going to see a massive amount of, announcements over the next, probably 2 weeks. You're going to see production, you're going to see CapEx coming down probably 30 to 35, 40%. And you're going to see production next year is going to be declining in the U.S. It's going to be the first time we've seen this in probably 4 or 5 years. I think that's what market participants want to see. They want to see a healthier market. It's getting washed out. Valuation will matter at some point, but we've got to get the coronavirus uncertainty. And we've got to get the uncertainty on OPEC, what they're doing right now and how long are they going to take this.
Well, we know what they're doing, which is they're fighting, and they've all retreated. It's every country for itself and every company in America for itself. Oh, if we could, guys, can we bring up a 10-year chart of the XOP, the Oil and Gas Services ETF? Because I want to focus on this, Mike. The XOP, it's a widely traded ETF. It's down 89% from its highs of just a couple of years ago. 89%. In other words, the market is predicting that many of these companies, and I don't think this is hyperbole or some sort of, fear-mongering statement, are going to go out of business. Is it that bad?
Yeah, you're probably going to see 15 or 20% of the companies will probably go out of business. But, I think what's going on right now is that, it is uncertainty and people are scared. What are we hearing from clients right now? Everybody wants to see these the companies on a $35 strip, into infinity. You don't usually see that at tops. You see that at bottoms. And so, when you say, you start dialing $35 oil, flat for 2 or 3 years, the valuations don't look good. We don't think oil is going to be at $35 a year from now. We think it's going to be higher. And so, yeah, we probably are in the 7th or 8th inning of this. It doesn't mean it can't get worse, but, we're seeing some good values. We're telling people to stay in the high-quality names. That hasn't really worked up to this point in time because everything's getting thrown at it indiscriminately. But, yeah, I think the industry is going to be healthier here in the next 12 to 18 months, and I do think that's going to be enough to bring generalists back to the group. Generalists did not want to get in this group simply because companies were just spending wildly. They weren't generating returns. They're going to be generating better returns, and when oil goes back to 45 or 50, the returns on capital are going to be pretty significant.
One quick final question, Mike, before we let you go. I know we got to get to Bob Pisani in just a second here. Here's my question. Hedging. A lot of people coming at me today saying, you're not counting the hedges, the market overreacted. The hedge books, I get it for this year. A lot of them, WPX and others, they've done well. What about next year? The data I'm seeing shows that hardly anybody is hedged at any limit for next year. We lost Mike Bradley, or he didn't like the question. Michael Bradley, if you can hear me, a little laugh there, much needed on a Monday night. All right, so we'll get more on oil and OPEC in just a second, but we are coming up here, well, it's 5:30 exactly right now, split down the middle. If you're just joining us out there, listen, a lot of people are stuck at home or they're working hard all day. They're not just sitting there watching the markets all day like we are. So let's go now to Bob Pisani to talk about the day that was. And Bob, you've been down at the NYSE now for how long? You're not trying to date yourself, but how long have you been down there for us?
23 years I've been the floor reporter at the New York Stock Exchange, and you don't see days like this very often, Brian, thank heavens. It was a double whammy. That's the problem. The inability to figure out the economic impact of coronavirus on corporate earnings, well, that's bad enough. We had to deal with that. Then you throw in a sudden price war between the Russians and the Saudis on oil, and you have the makings of a very ugly day and a particularly ugly open. That's what I concentrate on here. Within 3 minutes of the market open at 9:33 a.m. Eastern Time, the stocks were halted system-wide due to circuit breakers that kicked in when the S&P dropped 7%. That triggered a 15-minute trading halt. This was the first time that the modern circuit breakers had kicked in, and it did its job, basically. The job was to pause the market and create liquidity. Stocks then rose when the market reopened 15 minutes later, but the damage was done. We ended right near the lows for the day. Energy stocks in particular were clobbered. Exxon down 12%. That's the lowest close since 2004 for Exxon. If there is a poster child for the woes for energy, Halliburton, 3 trading halts, one for the S&P 500 at 9:33, and then 2 individual trading halts at 10 a.m. and 10:22. You see Halliburton closing down about 37%. Other economically sensitive groups also got hit hard, particularly banks and industrials. J.P. Morgan down 13% or so. That was the worst decline since the financial crisis in March 2009 on a single day. Industrials like Boeing, Caterpillar, United Technologies all down 9 to 13%. This wasn't, though, a complete bloodbath. We finally saw some differentiation in the marketplace. Some stuff held up a little bit better than others. Generally, they were consumer names, and not just Walmart. Walmart was the only stock that was up for most of the day, not at the close, but most of the day. Defensive names, Pfizer, United Health, down, but outperformed the broader market. Same with Procter & Gamble, same with Johnson & Johnson, same with Pfizer, all down 3 to 4%. Horrible days, but far outperformed the broader market, down 7.6%. Only good news here today is the circuit breaker did serve to sort of halt the horrible sentiment at the open, and the reopening things were a lot calmer, and the VIX, in fact, did drop after we reopened, although still very, very elevated. Brian, back to you.
Well, Bob, we are glad that you are down there. 23 years of historical knowledge and wisdom in dealing with this, never flustered. Bob Pisani. Tim, you lived in Russia. I want to ask you a question about OPEC, because if oil helped drive us down, okay, here's the thinking. And I wrote about it this weekend, by the way. I think it's still up on CBC.com. The Russians ostensibly wanted to punch U.S. shale in the face because Trump put sanctions on Rosneft. Rosneft is the big Russian oil company. It's run by Igor Sechin, who is Putin's former employee and ostensibly best friend.
Well, Trump didn't put sanctions on Russia. I mean, those were legacy sanctions. But
on Nord Stream, and put it this way: if the two can talk, you think there's any chance that there's anything we can do, back channel, to get Russia back to the table with the Saudis and get the OPEC deal done, which might stabilize oil and thus the market?
Yes, but ultimately you have to ask what is Russia's negotiating tactic and what are they trying to achieve? And my view, having spent a lot of time in Russia, is first of all, I can just tell you that the oil and gas industry gets more profitable as the ruble devalues and we get in crisis moments, because actually the oil prices are at higher levels of taxation, at higher levels of oil, but more importantly, they have local ruble-based costs, which actually get cheaper when the ruble devalues, and they are dollar exporters. So they're much more profitable in this kind of an environment. So Russia doesn't mind this environment. They also have a budget which fiscally breaks even at $43 a barrel. Saudis at 85 a barrel. So who's got more pain on the budget side? And Saudi's been very clear about their move away from oil and their 2030. And the chaos in Saudi Arabia right now that we're also hearing anecdotally, I think is something that Putin is seizing. This helps Putin's negotiating in the Middle East. Putin's got a game plan. He's got a game plan of helping Venezuela, other wounded OPEC players. This is part of the whole tactic. And I don't think Putin needs to rush to the table here, frankly. That's just a view. And therefore, it's a view I have that this volatility doesn't serve anybody. But U.S. shale is free cash flow positive above 50, and Putin knows that.
Yeah, what's interesting is I thought we wanted lower oil prices. I thought we wanted lower rates. I thought we wanted a lower dollar. Now you're getting everything you want, and look what's happening to the market. Sort of be careful what you wish for thing. So I'm sort of with Tim on this thing. I don't see any compelling reason for anybody to go to the table. It is it's economic warfare, and it pains me to say it. Right now, we appear to be losing.
42 used to be long-term support. This is what I've been saying for a couple of weeks / months here. I never expected it to break down this precipitously. But once you break down and you get below $30, then you're in a world of hurt. You look at that 26.55 level. So I don't know. I do still think that people, for the most part, want lower oil. They don't want it for this reason. But ultimately, a bunch of companies are going to go out of business. It's going to be survival of the fittest if anyone's left. And then we'll recoup, regrow. But until that, I think you're going to see lower for longer.
Yeah, and you heard Mike Bradley say it, 15 to 20% of the equities could be gone away. And by the way, many of them are down 99%. I mean, literally, that's a number. All right. The market crashing through several key technical levels in today's brutal sell-off. Is there any support anywhere out there? Cornerstone Macro's Carter Worth over at the Plasma. Any support anywhere, Carter?
Rubbing his hands together.
You just pick your levels. But let's first talk about the concept of a bear market. Now, headlines always focus on the 20%, and really no one knows where that came from. But let's use that. If the Russell 3000 is the broadest investment aggregate we have, covering essentially the entire investable universe, which is obviously the S&P 500 plus the next 2,500 stocks, these are the numbers. 2,467, 83% are already down 20. So is that a bear? Or how about down 25? 72% of the constituents are down 25. Or let's go a little further. How about 30? 60% of the constituents in the largest aggregate we have are already down 30. It's a bear market. You can call it what you want. We know what it is, and it's presumptively not over. Where can it go? It's anybody's guess, but let's look at some lines. So actually, same deck here for the S&P, and this is the point, right? 20%, 66%. More than half are down 25. So we have a few big marquee names that are holding up. As they succumb, we know what happens. So in terms of levels, here's the long-term chart. This is the financial crisis low, the 6th of March, 2009. This is the U.S. debt downgrade in 2011. Right here, the 2016 industrial earnings recession. Right here, the plunge low of December. And so were we simply to come down to trend, which is 2,500, that's another 7%. Perfectly reasonable. But the real question is, could we get to the December lows? Could we give back this entire ricochet of the past year? We know the S&P is not it, but the transports have already taken out the low. The bank index already taken out the low. The Russell 2000 and the energy. So let's look at each of those, and then let's quit. The S&P, were it to get down to its ricochet low of Christmas of 2018, would be another 15%. The Russell 2000, on the other hand, would be a mere 4. Just 4. That could happen tomorrow at 9:32. Could happen next week. But the point is that's a foregone conclusion. And then here's the real issue. Look at some of these other aggregates. What we have is the transports. The transports have already taken out their Christmas low. And the key here is they never could make a high, never confirming what the S&P was doing. And finally, take a look at the bank index. Never confirming the S&P's new high, and has taken out the low. None of this is good, and sure, you can get bounces along the way, but bear market, got a lot of problems, and let the dust settle before getting really excited about buying.
Yeah, we'll see if the dust does settle. Come on over. I mean, so Karen, if you look at Carter's chart there, I think I did the math a little bit. We're looking at about maybe we could have another 7 to 9% down on the S&P 500 to hit that 2,500 super long. Nice elbow. If you're on the radio, they just bump elbows. Super long-term support.
The trend line, right? Think about it. Those are pretty important reference points. The 09 low, the U.S. debt down in 2011, the 2016 low, and the 2018 low. Were we just to simply touch that, that's 7%. But from there, it's anybody's guess. The real issue is the market, which made a new high, was never confirmed by most global aggregates, by the banks, the transports, and it calls into question whether we do really test the December low.
So you had talked about the Russell as being only 4% off of that.
That unbelievable plunge low, at which point it was itself was down 30%.
So does that make it more attractive to you relative to the other ones? Or not, on a relative basis? I won't hold you to an absolute.
Yes, that's one way to look at it. One could say since it's so much worse, therefore it has more bounce potential. But I think it's because it's got so many things that are playing. First of all, its weighting in financials, as you know, is almost double that of the S&P, and small regional banks with rates and so forth are in real trouble. My hunch is that it's just it's a preview of coming attractions for the bigger indices.
And coming attractions are not things we tend to like to sit through.
I like the coming attraction. Sounds like a coming attraction of a bad movie. I mean, the bottom line is you see more downside likely ahead.
I think that's the message that I would convey, but I think it's also this. Let's say it's not about the downside. Switch the subject. Let's say we never go lower. There's always downside in investing. We know that. This is not tiddlywinks. It's about the upside. The upside is capped. If you look at the statistics on how long it takes to recover from a 20% decline, the median, it takes about 2 years. That's right. That's a problem.
And this may be where you're getting to, but let's cut right also to literally the shape of these charts. Investors are become so inured to expect a V-shape recovery. And we talk about it in the context of economies, and is it going to be a V-shaped recovery from the coronavirus? Who knows? But the charts themselves, that's a big ask. And
especially since we had the V off of the December.
Well, that's the reason they expect
it. V, right? And usually you don't. Meaning it's tricky to pull off a V. They're rare. U's are common. You heal, you cure. Ricochets are impetuous, impulsive, and they're rare.
All right, Carter, good stuff there on those charts. I mean, really long term, that Russell chart was incredibly dramatic. Carter, thank you very much. Need you at a time like this. All right, meantime, President Trump meeting with his economic team about the coronavirus and the economy and ostensibly the stock market. All within the past hour, let's get on to Eamon Javers, who is at the White House with more. Eamon.
Brian, we were told that meeting began shortly after 4 p.m. this afternoon. Not sure whether it's broken up or not, but I can tell you that the vice president's press conference on coronavirus, which was scheduled to start at 5:30, has now been pushed back to the top of 6 p.m., and they have replaced the vice presidential seal at the podium with the presidential seal at the podium. So it seems likely that we will hear from President Trump at the top of the hour now. And we may get a readout on what he decided, if anything, with his economic team. I was told they were going to go into that meeting and present the president with a list of options in terms of economic stimulus and response to the coronavirus economic damage that we've seen so far. So as you take a look at that podium now in the briefing room, we do expect to see the president there shortly here. And we'll also have a chance to ask him about his meetings upcoming with those Wall Street CEOs. That coming up on Wednesday. And then the vice president will be meeting here tomorrow with health insurance executives as well, all as part of the administration's coronavirus response. So we should have a little bit more news for you here in about 20 minutes time, Brian.
I don't want to put you on the spot, Eamon, with rumors and speculation, but I mean, I know you're there. You got your ear to the ground. You're literally seeing some of these folks walk around. Do you think there's any real shot of some kind of massive stimulus pack? I mean, literally, sending $1,000 check to small business owners or taxpayers?
They're skeptical of that idea here, right? I mean, on Friday, we heard Larry Kudlow dismiss that as helicopter money, pointing out that it hasn't worked in the past, when George W. Bush tried something similar. They don't like that idea here. On the other hand, that was about 3,000 points on the Dow ago that Larry Kudlow said that. So we'll see where the thinking is now. My sense is that what you've got here is a largely free market-oriented economic team and a largely protectionist president of the United States. And so those two things are not always on the same page. And the president is definitely one for big gestures. He's one to sort of go for the moonshot solutions a lot of the time. So you could see a scenario where the president looks at that menu and says, I'm going to go for the biggest possible option here. But we'll just have to wait and see. I don't know what they presented him with in that meeting, and that meeting may have just broken up or be about to break up right now.
Hey, Eamon, it's Tim. Can you talk about the health czar talking about the economy today? Can you explain what that was?
It was unusual. So that was the HHS Secretary, Alex Azar, who came out on the driveway behind me this morning. He was doing some television interviews on another network. Then afterward, he came over to where the press was gathered to try to get some questions to him. He came over to the microphones and gave a prepared statement about the stock market and said that the president has delivered the best economy and that the fundamentals of the economy are strong. He reacted to the stock market. He said it's been very active today, but the economy ultimately is strong. That's not a message you typically hear from the Secretary of Health and Human Services at the White House. Usually that's a Treasury Secretary message, a National Economic Council Director message. Presidents, typically don't talk about the stock market really much at all. But in this case, Azar clearly felt like he wanted to deliver that message. He came out, he delivered that message to the microphones, turned and walked away and didn't take a single question. So it was clearly a planned thing, but it's just an unusual thing for them to do that way.
Yep. Thank you.
All right, Eamon Javers, Eamon at the White House as we are waiting that press briefing as well. Guy Adami, if we got some kind of fiscal package, literally stimulus of some kind, small business, direct payments, right? Will that help the stock market?
Of course it will. I mean, and I don't know the answer to this. Steve does, and I actually don't know the answer. Are there circuit breakers on the way up?
No.
Yeah. Which is fascinating to me.
There used to be, I think, but now there's 11 different stock markets or something.
So you have stuff on the way down, but you don't really have that methodical.
Yeah, I bring it up to point out the absurdity of the whole thing. But absolutely. Now, quickly, if you can remember back to, I think it was February 8th, 2016, market traded down, the S&P traded down to 1810. If you recall, in August of the previous year, you had the China yuan deval, the market was on thin ice, and it cratered that day. In the aftermarket that day, you saw Jamie Dimon buy a significant portion of J.P. Morgan stock for himself when the stock, I think, was trading 53. I think you had a Deutsche Bank bond offering as well, and you had some sort of OPEC news, and you had three things. The market never looked back. If we get a hint of that, to your point...
Casinos were buying their stocks, too.
Absolutely. Yeah. Absolutely. If you get a hint of that, then yes is the answer. That's what the market wants. I'm not necessarily sure it's going to get it. But we'll see.
But I think, Brian, it's a case where we're talking about tonight is uncertainty. And yes, fiscal path forward can give you some confidence. I think it'd probably give you more confidence that politically we're able to get things done at a difficult time, which are in the best interest of the country. But I just think right now this is the issue with stepping in on multiple fronts. It doesn't mean that assets have to get a whole lot cheaper, but the grinding around in the sense that equities are going to V-shape and get away from you, even on a fiscal package, when you still don't know the credit story of a number of companies. And again, people are starting to talk about big industrial companies, but certainly go through those transports. And I don't want to name companies at this point. I do think that there are...
fiscal would help more than the monetary would help.
Let's not forget the stimulus package under Obama was passed, I think, February 11th or something, 2009. The market bottomed like a week later. Now, very different scenario than I get it, but if you're looking for any
equated to the circuit breakers
any kind of stimulus, whatever it is. All right, well, today's big sell-off tried to send some investors into gold, but not as much as you might have thought. Yeah, gold ticked higher a little bit, but certainly not the move many may have thought. Let's bring in Bill Baruch. Bill, thanks for joining us here on set. Thanks. Were you surprised? Was it just that everybody was selling so much, nobody had any money left over to buy gold? Seriously?
Yeah, that's a good point, because really, even if you look back at 2008, gold sold off in 2008. It wasn't until the aftermath, when it rallied in 2011, went to $1,900. Went down to about $800 in 2008. So I've traded gold for more than 15 years, cut my teeth on it. I've always lived by the narrative, you don't want to be buying gold when everybody's screaming for it. You want to be capitalizing on gold that you already own at that time. So I think gold's struggling around 1,700 right now. And today, you would imagine it should have gotten out above there. It couldn't. The high in gold, I think, came on the open in the S&P. The S&P sold off another 100 points. And so I think you don't want to chase gold up here. There's going to be a buying opportunity, and it's already up 11% this year. So you look from that standpoint, it's not the time to be buying. It's wait for a pullback here.
What about silver?
Yeah.
That's another great point. Look at all the metals. The metals got creamed. I think platinum was down $30, palladium was down $30, copper was down, silver can't get going. And I think that's another thing you want to keep a pulse on, because when silver finally turns, that could be the really great breakout that could send gold to new all-time highs if silver ever catches that bid. And the other thing to keep an eye on if you're trading gold is watch treasuries, the yields. And one thing that kind of concerns me a little bit in the near term is we've seen when quantitative easing QE1, QE2, QE3, yields bottom within a month of that every time. So if yields bottom and come up a little bit, that's not supportive for gold. But again, that aftermath is what will help gold break out.
So I got to tell you, been a gold. I never got gold. I never got it. So I thought a lot of the fundamental story was an inflation hedge, right? We couldn't be heading more toward a non-deflationary scenario. How is it that doesn't sort of undermine the gold bull?
Well, I think you're right. I mean, it's a narrative, I think, that's been flipped upside down. I mean, we're going into a deflationary environment right now. And really, I think gold's going to be driving off the dollar. If the dollar's weak, gold's going to be priced off dollars. And again, dollar was down a whole %, the dollar index today, and more than that maybe. But gold couldn't break out. So I think you got to kind of forget that narrative for a little bit. But there's times if we get an uptick in inflation, you've seen supportive for gold that day or that week.
Bill, when you look at Bitcoin, has it helped or hurt? It feels like it's helped the movement or the movement of money back into gold. And if you want to make a headline here, people have talked about $5,000 gold. What's your upside target long term? Do you have any multiple $1,000 target range? Because you hear it that it could be the 5,000 range.
You know, I don't put those really absurd or kind of outlandish targets out there. I think it is realistic to see gold above 2,000 and 2,200, 2,500 in the aftermath of this. Speaking of Bitcoin, though, I sort of took that off my radar, my everyday radar recently, or turn of last year. I think you got to keep a pulse on it. But look, I think was Bitcoin down 10% today, and the fact that it couldn't capitalize on that, I mean, it's not a safe haven. But again, where gold is, you would think it'd be a safe haven capitalizing on a day like this. It didn't. It's the aftermath.
We'll get you back on, talk about more of the industrial metals as well. Wonder what their signal is. Well, listen, all these companies, most valuable commodity in the world, we know what it is right now.
I have no idea.
Thank you very much. It's not gold. All right, let's talk about this. You're a gold guy.
I understand what he's saying. I mean, you go back to, I was actually working in 1987. I remember the day market was cratering, much percentage-wise, much worse than we're seeing over the last couple of weeks. And gold caught a bid, then all of a sudden it cratered. We saw it again, I think, 08, 09. There have been periods in history where you say, gold should go higher, and it doesn't. It actually makes sense for a myriad of reasons, not least of which source of funds or people getting out of things they have profits in. I happen to think gold, the story is not going away. And again, don't at me, but I think the next big problem is not going to be the rates continue to go down. It's when this genie is out of the bottle and you get this inflationary period where I know nobody thinks it's coming. First of all, there is inflation. The Fed just chooses not to measure it. Another conversation. Second of all, the turn in this is going to be so violent that the Fed's going to have no bullets, and that's when gold's going to be a story. There will be a time this year, in my opinion, where you walk in, it's up $200, people are looking around, and the next day it's up another. You can timestamp that sucker for me.
Guy Adami with the bold gold prediction. All right. Today's sell-off also drawing huge moves in the options market. In fact, let's get to Mike Cohen in San Francisco. Mike, they told me you're going to talk about tonight, and I said there's no way that that's true based on the stats, but apparently it is. Tell us about the put buying.
Yeah, so we were looking at HYG, which is the high-yield bond ETF. Now, it is conventional to see more puts than calls trade in this thing, but nothing like what we saw this morning. The put volume was outpacing calls by 50-1. And actually, of all of the ETFs, this was the second most active in terms of its put buying. And that's pretty extraordinary because the only one that was higher was SPY, which is obviously a much more heavily traded instrument overall. Implied volatility, which was right now we're looking at the price of 90-day at-the-money volatility in HYG, is basically at 10-year highs right now. And the activity that we were seeing that I was looking at, there's the March 81 puts, nearly 40,000 of those were traded for about $2. Those are making bearish bets in HYG that it could essentially retest levels that we saw in 2016. And actually, that's an interesting point because the 2016 lows, we are seeing stress, but we aren't seeing a crisis necessarily in these prices. A lot of the issuers, as you know, Brian, like in the energy space, for example, the equities are trading like grim death. this could potentially go a lot lower if we take a look at where yields are, which are still under 6%. So I think there is room potentially to the downside. That seems to be what some people are betting on.
Mike Coe, truly some unbelievable numbers there. Mike, thank you very much. All right, Tim Seymour, I honestly, I'm not the pro you are. I just don't know if I've ever heard of or seen those types of numbers.
Brian, you are a hell of a pro. Let's be clear about that. No, when we look at the HYG and you look, once again, maybe the term of the night, the word of the night, velocity, this moved down quickly to those Dec 24 2018 levels where high yield was hemorrhaging. And again, what happens is there's no bid. There's absolutely no one to step in. And what we heard from Mike on the energy side, what I was hearing from high yield and distressed traders that I speak to reasonably regularly, certainly during days like this, this is where we are. And there's no sense that assets have really found a price. Again, if you're looking at higher first lien loans in the high yield space, these things have gapped wider. So you can imagine as you get further down the curve. So what Mike Coe is telling us is that options traders or people that are playing in the high yield space view that this move is set to break those December 2018 lows, and this is a credit move that I think is going to be equity negative.
Okay.
Let me just add one thing real quick. The LQD, which is investment grade, that index also down. Normally, with rates lower, it goes higher, down a lot today.
Good point there. All right, so we are coming up at the top of the hour, and of course, several key markets in Asia. They are about ready to open for the day. Let's get your setup now with CNBC's Will Caloris, who is live for us in Sydney. Will.
I'm expecting another significant sell down when it does come to Asian markets. We saw the Nikkei coming off by around 5% yesterday. It's looking like an implied open of around 800 points down, which would suggest around a 4.5% drop. And it is interesting because the only strength we're seeing there is, of course, in the US dollar-yen cross, but also Australian markets are expecting another considerable sell down as well. Right now, the SPY futures are showing around about a 4.8% drop-off when it does come to the Australian markets. But I suppose the one saving grace is the fact that we've already taken our licks when it does come to the energy sector. They did see their worst day ever yesterday when it came to all those plays, and at the same time, we really hit that 30% drop-off already, so perhaps there will be a little bit of easement when it does come to those energy plays as well. And also, just quickly, I do want to touch on the fact that the Australian Prime Minister is speaking right now, and that fiscal stimulus is expected to come through shortly. So the hope is that we might perhaps see a little bit of a turnaround in the Australian markets moving forward, guys.
All right, Will Caloris in Sydney, waiting on that open. Maybe circuit breakers there. Will, thank you very much. We got some breaking news right now from Wilfred Frost joining us by phone about this meeting with Wall Street executives in the White House tomorrow. Wilfred, what can you tell us?
Hey, Brian. Yes, indeed. So I can confirm, not tomorrow, but on Wednesday, the White House meeting with President Trump will go ahead with the bank CEOs Wednesday, 3 p.m. Eastern Time. The nation's biggest 7 banks, from J.P. Morgan down to U.S. Bancorp and all in between, have been invited, maybe more as well, but certainly those 7 have been invited. And I know at least 2 of those will send their CEO, I would imagine. All would send their most senior executive and CEO, other than, of course, J.P. Morgan with Jamie Dimon currently out of action. Some industry bodies have been invited as well, including the ABA, the American Bankers Association. So this is shaping up to be quite a large and significant meeting. Not often you get all of those individuals in the room at the same time, of course, due to take place in the White House with the president Wednesday, 3 p.m. Eastern Time. Brian?
All right, Wilfred, thank you very much. Wednesday, 3 p.m. Eastern. I moved it up a day, Guy, but maybe they need to have it tomorrow instead of Wednesday. Will these executives be able to do anything about what happened in the stock market?
Not necessarily, but I think it'll definitely be a calming force. Look, again, we're not here to hype up when it's higher, to scare everybody when things are going lower. It is what it is. I mean, this is what we're living through. We got to deal with it. People getting together, it's not a bad thing. If something comes out of that, that's fantastic. I do believe, and Karen and I spoke about this earlier, there's going to be a day, whether it's this week or next, where you see the Dow Jones Industrial Average up anywhere from 2,500 to 3,000 points. It's not out of the realm of possibility, given what we've seen. And quickly, if you want just a something, Carter talked about it before, that 128 level or so in the IWM, the Russell, is a huge level. Now, if we can hold there, the Russell never verified the move up in the S&P, but if it can hold 128, maybe it'll lead us back to the way up in S&P 500. So for me, the most important thing today, at least, is that 128 level in the IWM.
All right, 128 on the IWM, guys. All right, so we got about 90 seconds left. We've been commercial free for the last hour, so let's try to figure something out for tomorrow. Not really a final trades, Tim, but just kind of getting texts like is the market going up tomorrow?
Well, and certainly like kind of a do's and don'ts. And certainly, look, my view is that there's been extreme selling and that there's many things that are oversold. And as much as I've harped on fear of credit, here's what I think you should do. I think you need to have a plan. So don't not have a plan. So forget the double negative. Have a plan on stocks that you want to own and at what level you want to own them.